Well, you can't vote.
You all set, Deb?
I'm not sure there's much voting tonight.
We're on.
All right, good evening, everyone. Welcome to the quarterly review meeting for the Fairfield Board of Finance. Would everyone please rise? I'm going to ask our recording secretary, Deb, to lead us in the Pledge of Allegiance tonight. So she always has to listen to us speak, so we might as well listen to her.
3 seconds.
I pledge allegiance.
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, I'd like to thank everyone for coming. I know we had several members who had some unavoidable conflicts. Mr. Brown, Mrs. Leclerc, Mr. Mayor, and Mr. Stone all had unavoidable conflicts tonight, but we do have a quorum. We have 5 main items on the agenda tonight. The items are to hear a report from the Joint Investment Pension Board on the current status of the pension funds. Item 2, to hear a report on the status of the Board of Education budget versus actual as of September 30th. We have some new reports there. Item number 3, to hear a report on the current status of the Fairfield Metro Center and a report from the Independent Council. So first we'll hear from the first selectman, then we'll hear a report from Independent Council that some of the other town bodies have heard previous to us. Next, we'll hear a report on the status of our budget versus actuals for the town as of September 30th. And the 5th item, we do have a small voting item tonight that Mr. Hiller specifically asked be added to the agenda. It's a transfer situation, and this is to make sure the books and records for the town for the last fiscal years are cleaned up. Does anybody have any questions, comments, or concerns? One other item of note, I'm told through discussions with the first selectman as well as the chief fiscal officer that we don't have any voting items right now for a previously planned meeting for next week. So it is anticipated that we will cancel that meeting. So we would not have a November meeting next week, should there be no voting items to come up, and we don't anticipate that there will be any. Is that correct, gentlemen? So you get a bit of a break next week. So with that, we'd like to welcome Mr. Malarkey from the Pension Board, along with Mr. Tetra and Mr. Hiller, I would imagine, to hear a report from the Joint Investment Pension Board on the current status of the pension funds. Please come forward. Good evening, gentlemen.
Good evening.
Good evening. You know who I am. I don't have my Halloween mask on yet. Let me introduce Bob Malarkey, who has served on the Town Employees Pension Board for approximately 6 years and currently serves as chairman of that board, and also, more importantly, right now, the chairman of the Joint Investment Board between the two boards, which was created by ordinance a couple of years ago, and has served very capably in that position for the past year plus.
Thank you and welcome.
Thanks for having us.
So go ahead, Mr. Hiller. Do you want to start off, or how do you want to go through
Well,
this?
I think we can be kind of interactive here. I did distribute to you this evening also, in compliance with the ordinance, the current investment policy guidelines for the pension board. As I believe this board is aware, we have recently, as of basically July 1st, changed consultants to Callan Associates. Our former consultant, Valuation Associates, was basically sold out, absorbed primarily into Mercer, who is a large investment consultant. Mercer does not take public clients, and there were 10 public clients who were in the Valuation Associates group, including ourselves and the city of Norwalk. And they had struck a deal with the Callan Associates, which is about the 5th largest consultant in the country. based out of San Francisco. We are serviced by the office out of Florham Park, New Jersey. We've had several meetings with that group. I would add also that the board has recently adopted a regular meeting schedule, and which I think is important, particularly at a time of transition. The board is going to be meeting as we move forward on the third Tuesday of every month. Have just met a week ago and are going to meet again on the 15th. And interestingly enough, the board, which I know is a concern to this body and has been discussed here before, we have commissioned a report from our actuaries, a experience study report. They are going to be reporting on an interim basis at the November 15th meeting, not final basis, because the final report will not be ready. And I know several members of this board, Mr. Brackfield in particular, and others, have expressed concern over the 8% discount rate utilized in our actuarial reports. So that report, we anticipate will be ready at some point, probably around the first of the year, but certainly in time for the budget deliberations of later in the winter.
So we typically get a report from the actuaries, a calculation from the actuaries of what the potential liability would be for the town and their recommendation funding for the next fiscal year. Will that be available to this board and to the administration for calculation of what that pension contribution should be for the next fiscal year?
We anticipate that it would be. We don't have a delivery date on it yet. They got the assignment roughly about a month ago, are working diligently on that, and I've been in contact basically on a weekly basis with our actuary, getting some updated status on that, and I think, we should see right after the holidays that report. I don't know that they're going to have a specific recommendation in there. I think with, they will give options. And I think then the option, clearly, if one looks at this over, as Mr. Brackfield has, and seen some of the reports over the last 10 years, we have been significantly below, as has virtually every other pension fund over an extended period, under the 8% return level.
Right. But what I'm asking is, I know that report is not going to give the actual answer, but what will happen from that report is the pension board, I'm assuming, will update some of the actual estimates that you use to manage the fund, and that should in turn be fed to the actuaries, I would assume, so that when they do the calculation as to what their recommendation is to us for the funding for next year, what I want to know is, will that be available to this body for the budget season?
Yes.
Okay.
Yeah, I can't give you an exact date. We don't have a delivery date on that, but I think, when you consider that the administration decisions will be made primarily in the month of January, and since this is, and also because it also impacts the Board of Education budget
Right.
too, those decisions, it's incumbent upon us that we get that as soon as possible. And it's a critical decision, and this is a national debate, as you're well aware.
Okay. Thank you for that. So now we have the investment report from June 30th to review?
That is correct. One of the other questions, or one of the other parts of the ordinance, as it was adopted by the RTM, or what were the expenses incurred by the board. I did hand out the, which our auditors use, the consolidated investment statement. And you will see the administrative and investment expenses, about the fifth or sixth line down on that sheet, are
Yeah, which,
on the single sheet, People's Bank.
is
United
People's Bank.
Sheet. About the fifth or sixth line down in the body. $1,095,000 were the investment expenses. $187,000 of that was for the custodial expenses and the administrative expenses of People's United Bank. And the balance of that, or just over $900,000, were the investment fees paid to what I'll call our fee managers. That number might be considered slightly misleading because there are other fees that are embedded in some of the other managers that we have. We utilize the services of 6 active managers who get paid on a basis of so many basis points on the value of the funds that they manage. There obviously are other fees that are not as easily tracked as far as, but this is an actual cash expenditure of the fund. I assure you that the expenses would be in excess of $1.1 million.
Paul, I'm sorry, Tom. Oh, I apologize, I didn't see you there. Go ahead. Go
We're
ahead,
going to
Rob.
go with Mr.
Yeah,
Polito. He
just a
was-
quick question. The People's Bank statement, is that the entirety of all the holdings we have in the 2 pension funds, or is there stuff that's not accounted for on this sheet?
This sheet here is their reconciliation, which has been given to the auditors. It will be, and the auditors will use this and, you know, those 2 big volumes over there that I have to reconcile the account.
But is this the
Is this
total?
just everything? This is
That's
all of it?
the total value of the funds.
That's what I want to know. Thank you.
$294.5 million essentially between the 2 funds.
Mr. Brockville, I'm sorry, you were done.
I'm done.
Please.
Are we just doing questions as they come, or?
Yeah,
Okay,
absolutely.
so I have a couple of questions for you guys. But one would be referring to these fees you just described. The $1,095,000 or so, Paul, you're implying, so on the managed equity funds or managed funds, we actually pay those, in other words, most funds, like if you own Fidelity Magellan, right, there's a management fee, but it's actually, you don't cut them a check, right? It's just,
Correct.
it's subtracted on a daily basis, actually, from your
Correct.
net asset value. So we're actually paying,
We're paying cash.
okay,
We're paying, we get in every case, and as I say, there are 6 managers who are in that category, 2 fixed income managers and 4 active equity managers. They bill us on a quarterly basis. They've been given a certain amount of funds to manage. Their fees are deducted from those funds. So when we see if they have 25 million to manage and they send us a bill for $40,000, let's say, that $40,000 is taken out
right.
of the 25 million.
But we actually see an invoice, so to speak.
We do get invoices from them.
That's good, actually.
On a quarterly basis, yes.
Okay, good. Can I continue, Tom?
Yes, and, yep.
A couple of questions. One is, and I think I know the answer, but well, actually, I don't know the answer. If you look at our asset allocation, you'll see that we have 41% domestic equity versus a target of 25. Now, I know why. I can see why that is, because it looks like you guys haven't completed going into some of the alternative stuff, which actually, if you add up, would almost equal, right. The question I have for you is, why would the differential be in the equity area and not in, for example, the bond area? In other words, you know, I'm trying to,
And Bob can chime in here, we've been overweight in equities for an extended period of time. We made, as this board is aware, some 2 years, a little over 2 years ago, we had a significant investment in Pequot Capital, which was shutting down. We received, we continued, as you can see on the asset sheets, we still have a little over $1 million of assets with Pequot Capital. But that was, at the time, there was a significant amount of cash that came in. We have been, at that point, we also went into, I forget the exact amount that we put into an exchange-traded fund.
right.
Standard & Poor's exchange-traded fund, and also an international exchange-traded fund, which brought us overweight into that category, underweight in the equities. And I think one of the concerns that the board had, that when we had adopted the asset allocation policy of, and this is under review by Callan, but it was a 23% allocation to alternative investments. We have been significantly underweight there. We've started to change that. as of last week. The board made a commitment to a commodities manager at a 3% level, or roughly $8.5 million, which will be liquidated in the next 30 days, and primarily out of the overweight positions in equities.
Right, okay, because it just seems to me that, like I said, I understand the math.
Yeah.
But if the money's sort of waiting to be reallocated, it wouldn't necessarily make sense to have it in the highest risk area if you really only want to have 25, or actually combine with international 45, and you have closer to 60. I'm just wondering if that was a conscious effort, or if it just sort of
It was,
happened.
well, I think, and I think one of my frustrations is, and I'm sure Bob's, we've been plodding along trying to move this stuff into the alternative classes to meet the asset allocation model. I think with Callan, we've picked up pace on that. We had a very good presentation last Tuesday night from 4 active commodity managers. I believe at the December meeting, they plan to bring in private equity managers. I've had 2 conversations with their consultants on that in the last 2 weeks. And Callan will not, the 2 lead people have a conflict because when we had established the third Tuesday date, they were already conflicted on that date, and we were aware of that. But there will be a representative from Callan present at the meeting, but not the 2 lead guys.
Okay. 2 other questions, Tom, if it's okay. One is, could you, one frustration for me, and it's nobody's fault per se, is that we're sitting here on October 26th, and we're dealing with June 30th
I was going to ask the same
numbers.
question.
And on one hand, I know the advisor's going to say it's hard to put it together. On the other hand, this shouldn't be, I don't think it should be this far behind, personally. So-
We didn't do as well, not that we're trying.
Yeah, so, but I just, because,
It was
the
not a
market,
great quarter.
we're living in very volatile markets, and,
Yeah.
to be, whatever it is, almost 4 months behind is a little, so, one of the questions I had at the last presentation, when, Bob, you weren't able to be here, Brian Vahey was here in your place.
Yep.
Can you tell us a little bit, Paul, about, or Bob, how the hedge funds that we have gone into are performing so far? As far as you know, obviously, I don't know how recent you have reports or numbers. And then I just have one more question, I'll be finished.
Sure.
No, really.
Is Mr. Hiller looking for the answer for that? Is that the,
I suppose.
yeah. Mr. Hiller, is that what you're doing?
I wanted to get the exact figures.
Okay.
I don't have the exact figures.
I have the numbers from June to July to August. I don't have the end of September's numbers.
Okay.
But as you can see, the Wellington Archipelago has pretty much maintained the same. It's, the value as of August 31st is the exact same here, 9.7 million. Conatus has dropped down a little bit from 5.2 million to 4.7.
It's more than a little.
Yeah,
That's a big drop.
yep. But that's kind of what we were, we're prone to.
No, I know they're
So
volatile.
to look at it every
Yeah.
month, we kind of go through this. And then the Pequot number is the other number.
Yeah, no, it's
And that's
not.
pretty much the exact same that it's been.
Okay. So these are volatile instruments, and we accept that and hope they'll perform long-term. Is that a fair?
Yeah, Conatus is an individual fund, and, which we entered in February 1st, $5 million commitment. And as you can see there, and Bob has the figures through August 31st, which were the 4.76. I had the figures, I get a weekly report from them, but not, I only get it as a percentage basis. Not exactly what our fund, but I could interpolate that into where we are. They were down in September, they're up in October,
Okay.
month to date.
Okay. As long as you guys are carefully monitoring the alternative
Yeah.
stuff, I mean, that's just one of my big concerns. Last question for you, and it goes back to what Tom started asking you before, because one of the things, I'm still a little unclear as to what you guys are doing for us on this study, I guess, that you asked the is it the consultant or the
Holcomb.
actuary?
Hooker and Holcomb.
Hooker and Holmes, the actuary, right.
Yeah.
So and I think, Tom, this goes a bit to what you were asking, because I'm not 100% clear. It's pretty clear to me, at least, that you probably won't be in any position to necessarily change the 8%, even if you were inclined to, before this year's budget comes up. That would be a pretty fast decision. You're just getting a recommendation back now.
That's what I was asking, right.
Right. So, but what I've asked for from this, even when I was on the pension board and from here, and I think I have some support from my members here, is a sensitivity analysis. And you might be, and I'm just hoping this is what you've asked for. In other words, even if you guys choose not to do anything about the 8% in such a quick fashion, what I'm interested in is what our liabilities over, say, a 5-year window are if we were to get 6%, if we were to get 6.5%, if we were to get 7%, and to make it a happy outcome, maybe if we were to get 9%. It's unlikely, but so that's really important to me. That's part of what you request and will be furnished to us, because I've been a big advocate that if we don't know what some of the possible future outcomes are, it's difficult for us to make long-term commitments on capital projects, for example. So is that?
Oh, I agree. It's definitely time to do this study, the experience study, as well as the asset liability study.
Right.
One-
Yeah, go ahead.
One of the things that we were doing was kind of putting it out to an alternative to Hooker and Holcomb. But there was an expense associated with that. For somebody to start from the beginning, going through all the books, versus using somebody who was already, has a background, has all the numbers. So that was part of it. That would have been a longer duration to go outside. So we just, at the last meeting, or was it the September meeting? Decided that we would use the Hooker and Holcomb and gave them the go-ahead to start the experience study
So maybe.
as of November.
Okay. So maybe I'm not asking this right. Actually, I'm not interested. Experience is the wrong word for me, at least. I'm looking at the future. In other words, it doesn't. We have X dollars in our pension fund today.
Sure.
Right. If we were to get 8%, which is what we assume, then we will owe over the next couple of years. We're going to owe, or actually, owe is the wrong word. We're going to have to contribute a certain amount into our pension fund.
Right.
And unless there's dramatic changes from the last year's presentation, we know the numbers. They ramp up to about, what is it, about $17 million or something in 4 years.
Over a 5-year period.
Over
I
four-
think
yeah,
when it goes out to
well, actually,
fiscal
not-
16 or so.
In 4 years from now, right. But if we in fact were to experience 7% rather than 8%, those numbers would be much higher. And if we were to experience 9 rather than 8, obviously it'd be much better. So that's what I know our board is looking for. And it doesn't sound like that's what you guys have asked for.
I think you're going to get that, Bob, because I think, I remind this board, and we can send the notice to this board too, that when the actuary comes in on the 15th, certain members of this board may want to be at that meeting when she's there. Because I think one of the things, and it's unclear, the question has been asked here before, who makes that decision on the discount rate?
Well, again, not to interrupt you, Paul, I'm not sitting here in any way, shape, or form advocating for a particular number. I think this
understand.
seems to be a continual confusion. I'm asking, but as I said, I think the board, over the course of time, has also expressed an interest in seeing the potential outcomes at different rates.
Yeah,
No different than if you were running your household budget and you just wanted to take a look at what your,
But I think what that gets to, though, is the point is to, and this is where this board is an integral part of that. We have an asset allocation study, which our consultants will tell you should drive a return, and it's not 8%. It's a little bit below that 8% level, based on this model. The question comes as to what is the budgetary stomach, let's say, to be able to swallow a 7%, a 7.5% discount rate. There can be a dramatic impact as you lower that by.
Well, time out for a second, though,
Yeah, we
because
question
I think
different things.
we got two partial things here. We did, in fact, ask for a review of the experience.
Correct.
And Mr. Vahey had been here back in budget time, and then he was kind enough to come back last time. And what we had talked about was what I think you would refer to as an experience review, because the thing that we wanted to be clear about was you needed to look at all of the assumptions, not just the 8% return, because there's the other levers in there regarding retirement age, lifespan, and it was really based on what our experience level has been, which I think is what you've asked the actuaries for,
Yes.
right? Along with that, Mr. Brockfeld is absolutely correct. We then took and said, okay, the single biggest driver of that future liability, even when you factor in all the others, is that rate of return on the investment on an annualized basis. And you've been very clear several times in saying that you would like
Yeah, I think so.
something that says, and very clear, I might add, in saying that you're not advocating for a number. You're saying you want essentially a sensitivity analysis that
Right.
says, what does half a point difference either way mean to us?
Right.
In terms of the additional expense.
Right.
I think we've also, over the last couple of years, established a precedent of following the results of the actuarial report and funding to that level, knowing that we were trying to keep it as close to that 100% marker. We're not there, okay, but as close as we could. And I don't, from my perspective, don't see why we would deviate from that when we're also already have an issue on the OPEB side of the house. So we've got to deal with an issue that's already there. I don't think we want to create another one, and I think that's the reason we asked for from our chairs, asked for the updated study, and I think at the same time, the ladies and gentlemen of the pension board were asking the same questions on your side. Is that fair enough? So I guess the point still stands. They're doing the experience study.
Right. It
Are they
doesn't
going to do a
sound-
sensitivity study on, which is just purely a mathematical calculation at different rates? I would assume,
I'm confident in my discussions with the actuary that you're going to see that.
okay,
And we can reinforce that with her on the 15th.
great.
We will ask for that.
Then,
No, I appreciate it.
Yep.
Yeah,
okay, does that help?
Definitely.
Okay. Can I jump in for a couple questions with my colleagues? Real quick, the accountant in me comes out. So I have this schedule, which foots to a bottom line number of 294,490. Okay, 294,490,000. I have this schedule dated the same date, which is the quarterly investment report from Callan and Associates. And the number on here comes to 293,456. So there's a difference of 1,044,000. And I actually been trying to find it on here.
You won't.
Okay, then we've got another question.
The primary difference is, and I know you had brought this up, I think, at the last time, and it is a frustration, particularly in the alternative investments. We didn't get the values on the private equity investment, which is in a group called Lexington Partners, until mid-September. And the report from the custodial bank, I don't see any date on that, but we didn't get this report for the auditors until late September. And so there were some variances, there were several variances, but it's all in the alternative areas. Obviously, the active managers who, I could tell you tonight what they had as of close tonight. I could go back to my computer and tell you exactly where they are. With the alternative managers, we're not getting values probably in the 75-day after close.
Okay, so what that tells me then is that the percentages in this model, which Mr. Brockfeld was referring to before, are
Yeah.
inaccurate.
Slightly.
Okay, so basically what we need for next time is a reconciliation
Yep.
from this document to this document so that we're all on the same page. Yeah, please, Mr. DeWitt.
I guess what I don't understand from that statement is, these are supposed to be two equal statements on the exact same date. So whether you got the information on September 30th or July 1st, why is it different?
Because, well, the problem is this, the report from Callan, June 30th, was created, I believe, on August 18th, and didn't have certain data from the alternative managers.
They didn't even have data from June in August?
I'm sorry?
They didn't have data for June 30th in August?
We didn't have it until mid-September.
June's data?
Correct.
Wow, really?
For some of the alternatives
Goes
investments.
right back to
Paul, is that,
Rockfield's question to start with.
Well, I guess, actually, I don't know, is that standard in the?
Wow, yeah, that's really great.
It appears to, our relationship primarily with we have two investments in the alternative area with Lexington Partners. They're not big investments right now, but we have a $5 million commitment in both cases. Lexington Partners is a secondary market private equity fund, and TA Realty is a realty fund managed out of Boston. The realty fund, they have drawn most of the funds that we've committed to them. The private equity fund still has a significant amount of cash. We had a draw today with them of 136,000 more that they drew today. But
You just argued against your own answer, though. Because cash is cash, so if they didn't have to revalue it,
Yeah,
there
they-
shouldn't be that much difference in the number from June 30th.
they haven't, but they've been, as we've been ramping up with this group, they haven't been providing timely reporting, let's say. I'm going
Perhaps we
going
should
to their
slow
annual
the
meeting
ramp up.
2 weeks from tomorrow.
Perhaps we should slow the ramp
and
up
see what we
if they're
can-
not. Mr. Malarkey, is this common to have reports 75 days after the quarter?
No, I think we've given them a little bit of time to catch up because they came in so quickly. You know, one day Evaluation Associates is there, and then the next day Canadas comes in. We kind of gave them credit for showing up and trying to ramp up pretty quick, but
Okay.
this is something that,
So this is a hiccup and not a long-standing issue that you're having
hope
with
so.
valuation?
Well, are you implying that this is Callan's responsibility rather than the hedge funds or the alternative?
I think in that one case, it's more Lexington's responsibility. As Bob points out, I think that the transition, we did get, which I didn't bring, we did get two separate reports as of June 30th, but they're identical. It just has a different logo on it from Evaluation Associates in Callan.
Can we get to the bottom of it for the next quarterly report, just so that we understand better? Because it does throw off your percentages that you gentlemen are trying to manage to, that you spoke to before, and it just doesn't seem right that it's so long a period of time.
Well, actually, I appreciate that. My bigger
Yeah.
concern, I mean,
Yeah.
you're speaking as an accounting
Yep,
thought, and I think that's appropriate, but my bigger concern, and again, I'm trying very carefully not to manage your fund from this seat, but is that the issue of appropriateness of alternatives is a whole different story, but these are the most, by definition, most volatile and risky
right.
items we have, and they may be a place for them, but it strikes me as a little concerning that we have such a long window of knowing the returns, because these are the items where problems can come up. And, if you're not, 75 days
Exactly.
is a long time. And I, just from my own experience, I mean, hedge funds price daily if you ask them to. Paul knows that. You used to have Pequot's numbers on a daily basis. So
The other concern, really, and I think one of the things that that the board is trying to manage with the assistance of the consultant, is the liquidity of some of these funds is difficult.
If you're not
And it's-
valuing them for 75 days, they're not real.
Well, yeah, but you see, they have lockup provisions. We can't get to a lot of this stuff. We can get to an exchange-traded fund tomorrow. We can't get to the money in Lexington, next month. We can't get there right now.
Okay.
And that's a concern, because we're paying out, or we'll be paying out this year, probably in the next fiscal year, probably in excess of 17 million in beneficiary payments. And we've got to have liquidity within the fund to meet that beyond the employer and the employee contributions.
My last question on this, and I asked this last time, and now we're looking at June, so there's the definition of the asset classes, or the allocation mix within the asset classes that Mr. Brockfeld spoke about. Within the asset classes, as I recall, and I haven't read it because you just passed it out tonight, I think within the investment policy, there's some guidelines as to maximum investment in any individual fund or investment. And last time we were here, there was some concern that in some of those, due to market fluctuations more than anything else, right, we had exceeded the investment limits on a percentage basis in some of those individual investments. Do we have that same issue in June, or is that getting better?
We didn't have it in June. We had that issue, and Bob and I have had several emails just
Came up
today.
again.
We've had it
Last
in the
couple of
last
weeks.
quarter.
For
And the board, one of our large cap equity manager had a significant investment and significant profit in Apple. And our policy on that is 5%. I've been on the phone several times over the last week with my contact at Columbus Circle. We've asked them to come to the meeting on November 15th. They got up over 6% and were there for an extended period of time.
So you guys are closely monitoring it and addressing
Well,
it as soon as you go
I don't,
over?
in all honesty, Tom, I can't say that we are closely, they wrote us and told us, and they had some rationale as to why they wanted to stay there. They came to us, we were 4 days away from a meeting, and we, in consultation with Mr. Malarkey and Mr. Tetro and myself, we said, let's wait till the board meets, and, you know, we've been there at that point for 60 days, roughly. We went over in mid-July on that one. The benchmark went over. They're benched against the Russell 1000 growth, and they were tracking the benchmark on it, and that was the problem. It was also at a point in time when a lot of equities were going down, and this one was going up. We gave directions, and they have, as of this week, they have liquidated that position below the 5% level. And they've got some, one of the concerns of a couple of the members, and rightfully so, is their internal controls as to how they let it get there and didn't notify us until over 2 months later.
Yeah, I would say that's not,
That's a compliance issue.
yeah. And is that Callan, or who's that? That's the individual
That would be
fund manager who's managing that fund?
Columbus Circle.
It should be within their, you know, they should have it triggered, and fortunately, we've got several people who are in the industry, and they've been looking at it, and it should have been on their radar screen before they came to us,
Right.
that we've gone over here.
So it sounds like we have some tightening up to do across the entire management structure on that. It sounds like there's some tightening up that you would like at the individual investment level for the monitoring, for going over your stipulations, right, to be in compliance. And it sounds like there's also some tightening up, particularly in the alternative investment area, related to timeliness of information, right?
Sure. Yep.
Can I just piggyback on that particular
Is
point?
there- you all set with that?
If that's okay, Rob?
Yeah, go ahead, go ahead.
Because it's
Okay.
directly what you were
Yeah.
talking about. Where I thought Tom was going, I mean, that's interesting with Apple, but where I thought he was going, and I think we've had this discussion, is that the guidelines say we shouldn't have more than 15% with any manager.
That's correct.
And we have 19.1% and 15.9% with our two fixed income managers.
two
I
fixed
understand-
income
I can see
managers,
how it
and
got
the
there
intent
because
is
fixed
to-
income has been such an outperformer. But is there a plan to diversify?
rebalance?
Into it, well, I think you'd want to bring on a third fixed income manager if you're going to keep this amount, you know, if you're going to keep 35% of the fund in fixed income, I'm not sure you are, but then by
It
definition.
would have to
you're-
overflow to someone
you're going to have a
else.
problem perpetually there. And, you know, and Paul and I know this because we dealt with the Dwight thing. Fixed income isn't the sleepy business it used to be. It's fairly volatile as well. So unless is there an exception for fixed income, Paul, that I don't know about, or it's not in this? Because this thing says 15%. I was asking, is there some exception for fixed income?
In adopting that, we were aware of that, and I think, again, this was one of some of the targets that Callan has talked about is getting down into the 25% on fixed income, significantly below the current levels. And again, it's moving this thing forward, which the board is now, I think, committed to do, and I would hope that by the end of March, let's say, that we will have that asset allocation study, not study, but the decisions that have been made for that allocation study will be positioned properly.
Let me just ask one. The only thing that concerns me on this, and I think this does go to our board, is that I can see where you're going with that, but in the short term, you're I hate to use this word, violating the
Yep.
the
policy.
in policy.
Our own rule.
Right, and the easiest way to deal with that would be to simply open up a bond ETF, rotate some of this money in there temporarily. You'll get essentially the same performance anyway, and then you can decide how to
Rebalance your asset
and so forth and so on. But I don't think we'd want to be at 20% on an individual fund when the rule says 15 for more than
Good point.
a very short time.
Exactly.
I think this is one of the things we'll be cleaning up by meeting on a regular basis.
Right.
Yeah.
You know, we have been informal for too long, and we've just recently been made aware that we are formal and set a precedent where we are meeting the third Tuesday of every month, and I think the more we're in it, the more we'll pick up on those things. Getting back to the Columbus Circle thing, I mean, there were two issues with that. One was the length of time before we were notified.
Yeah.
And then the other thing was them asking us to make a decision that went beyond our guidelines.
Right.
So those were two issues that we have with them that we plan on addressing with them. And I've had a couple of board members that have offered to tour their compliance department. So it is of concern. It is in our radar screen
Yeah.
to take care of. And then this will be too. Yeah.
Thank you very much. I'm going to go to Mr. Bolito. Mr. Collins, did you have something?
Thank you, Mr. Chairman. Back to hedge funds for one moment. There's one thing I didn't quite understand. Pequot is closed down, but we still have assets with Pequot. Are those eventually going to be zeroed out? Is that the plan?
We would anticipate that by the end of our fiscal year, that will be zeroed out. They hold assets which are held in trust at Wilmington Trust. We have contact with Wilmington Trust. There are, it's, for any one of us individually, it's a lot of money, but for the fund, it's not a significant amount of money. They have been paying down on a regular basis. We know essentially what they're holding. They are holding some mortgage-backed securities in debt, which are paying down. And they also have in the major fund, which is Pequot Endowment Fund, they hold and we hold an investment in a private equity corporation, which is, they are working with an investment banker to liquidate that position. And they had hoped to be able to do that by the end of the calendar year. The latest communication is that it's going to be well into the first quarter of next year, and my guess it would be, and I don't have anything in writing on this, but we won't see final closeout on that until the second quarter or our final quarter.
Okay. I seem to recall at some point, and maybe I'm not remembering correctly, but that we were getting something like 60 cents to the dollar back from them. Is that in the ballpark?
No, we're probably, we've gotten back
Bless you.
about
Bless you.
98% right now, and the
Okay.
indications are that we'll get back more than 100 cents on the dollar.
Oh, excellent. All right. Now, just a general question. You guys are pros at this, and when it comes to investments, I'm more of a layperson. So explain to me how investing in hedge funds does not violate the Uniform Prudent Investor Act, because there's a requirement in there that you preserve principal. That's one of the benchmarks. So the whole hedge fund thing, the appropriateness of it has always been a bugaboo with me. Just explain to me how that's appropriate under the Uniform Prudent Investor Act.
I think and I will speak as myself, as a voting member of the board. The intent has been basically to spread our risk, in theory. They hold significant short positions against long positions. The hedge fund that we are in individually sends us weekly statements as to what their attribution is within the fund, where they're long and short. They tell us what industries they're in, and they are well diversified. Before we selected this particular hedge fund, which was on the advice of Evaluation Associates, several of us went down to their office, which is in Greenwich. We had talked to 2 other hedge funds at that time. The fund had had an enormously successful investment with Pequot Capital, in which the gains over the life of the investment there are in excess of 1,100%. And that's a good return.
Sure.
So I think, the board, and there's been a great deal of transition on the board, but the board, along with their consultants, has a fairly high level of confidence in hedge funds. I think the one thing that both Evaluation Associates, and more particularly Callan Associates, since that's what we're dealing with now, has a very strong prejudice, shall I say, towards fund-to-funds in this area, where we're picking, or letting someone else pick that as opposed to our, we got lucky on Pequot, very frankly. And if you go back over the tenure of time we were there, and what part of the attitude is, go find us the next Pequot. That's not easy. And what I think Callan is trying to say to us, what you got to do is find someone else who's going to spread this risk, as the Wellington investment is doing, because they're in 7 or 8 different funds as we speak.
Right. So is the risk inherent in these type of funds worth the potential for higher returns that you would get with the traditional investment, in your estimation?
That's a great debate, Rob. I think, that the fees that these people can make are significant, first off. Because first off, they have incentive fees, which are substantial.
Fees for who? I'm sorry, I didn't catch that.
Hedge fund managers.
Hedge
Managers,
fund
right,
managers. We're on a what's called a 2 and 20 with Canadas, where we're paying them, and this is one of the fees it's not showing up here on that fee structure, and so, but that's coming out of the $5 million that we've given them. They've got to produce to get their
Paul, why don't you explain what 2 and 20 is?
2 and 20 is that of the $5 million that we've given them, they're entitled to a 2% fee on that, as a management fee on that money. If they make money over the period of time that was given, over that period of time, they're entitled to 20% of the profits. So
basically, they have an incentive to put forth a highly performing product, is what you're saying. So that's the driver behind the high rate of return, because if they don't generate a high rate of return, they don't get paid, essentially, or get paid what they could.
they're back to the 2%, which is still high, because our equity managers, our highest equity manager, which is the Boston company,
I'm running for the wrong job.
is getting paid 90 basis points,
Yeah,
as opposed to 200.
okay. Mr. Malarkey, what's your opinion on it?
Well, I rely, to be honest with you, on the expertise of a lot of the makeup of our board, who have a lot more experience in that. There's a percentage of us that don't have much experience.
Yeah.
So what I do is make sure that we're following the guidelines, the investment policy. And our Canadas fund was explained to us in great detail by Evaluation Associates, so that as we made these decisions, we all felt a great deal of comfort, whether we were a librarian or a insurance person or somebody who does this day in and day out. My belief is that hedge funds need to be in this to a small degree to help balance other investments.
Okay, fair
So
enough.
that's my comfort level with it.
One last question on it, and then I'll give it up. The fact that hedge funds are not required by the federal government to report as other types of investments are. What level of concern does that generate with you in terms of the accuracy of the information you're getting? Because you don't get a prospectus per se, I'm assuming. You get information that's provided by the people who are in the fund, which may or may not be accurate, as obviously was the case with Madoff. So how are you sure that the information you're getting is correct and accurate when you don't have that federal backstop to make sure it's accurate? Not that that always works, but at least it's a better than average shot.
I think the most important thing here, and obviously there's been, in the hedge fund industry, there's been a lot over the last 10 years of what I will term headline risk. This board is well aware of an incident 3 years ago, which we had a lot of headline risk in another investment.
Right.
I think the key thing that we attempted to do in selecting Canadas is really do, through our consultant, a lot of due diligence to go down there to see who their counterparties are, who the brokers that they're dealing with. They are dealing, I'm going from memory exactly, but the primary broker they have is Morgan Stanley. Morgan Stanley, Goldman Sachs, and Merrill Lynch, I believe. Don't hold me exactly to that, but highly respected and highly, big firms. Their legal staffs, their audit staffs, et cetera, are all of first quality. And at some point, it has to become a judgment call.
Sure. So you're basing it on your due diligence, is what you're saying?
I've been down there, I've been to their offices a couple of times. They're at Greenwich Plaza, which is the office adjacent to the Greenwich Railroad Station. Not that that means anything, but I've talked to their people. No, it doesn't.
It really
It
doesn't.
means they're paying,
Fast, that's a good thing, I guess.
it means they're paying a lot for rent. And,
I got you. I understand and I appreciate that.
Let me put it this way, Rob. I think we've done as much due diligence as we can in that, and, I personally have a level of confidence in David Stemmerman, who's the principal, who's the general partner in the fund, and
Okay.
I hope he wins. I hope he gets to collect some 20%. Right now, he's not.
Fair enough. Thank you very much.
Can I go to Mr. Kiley?
Thank you,
Thank you,
Mr.
Mr.
Chairman. Paul, if I heard you correctly earlier on the private equity section of the investment analysis allocation, you mentioned that while Lexington Partner has only drawn 1.1 million plus whatever they've recently drawn, that there is a $5 million commitment for them?
Correct.
Okay. So at some point in time, obviously going through the proper processes, they're able to draw more funds into their, they're able to draw more money into their funds. So my question is, the delta, the $3.9 million that they would have eligible to draw based on this math, where would that money be today?
It would primarily come, as I say, we just had one capital call from them today. We usually know about 2 weeks in advance that it's coming.
Where would you pull it from within here, Paul?
That's my
We pulled
question.
it from what's called the transition account.
Okay.
So you only have $1 million in the transition
The
account.
transition account as of August 30th.
And there's $600K in
$6.5
cash.
million.
Okay, so it's $6.5 million as of August 30th?
I'm sorry?
The transition account is $6.5 million as of August 30th?
Yes.
That transition's got 6.5, okay.
Yeah.
The schedule doesn't show that, okay.
Because it's June. Yeah.
Okay. So potentially, the money's there for them to draw should they request it. Are there any restrictions on how much they can draw, how often they can draw, or could they come tomorrow and say, we want the 3.9?
They've usually been giving roughly about 15-day notification.
Understood. But is there like a limit, like the 130K they
I'd have to go
took
back to their contract, Kevin, to look at it.
Okay.
The most they've drawn is in roughly in about the 500,000 level right now. This is what in the industry is known as a secondary fund. They're basically buying secondary pieces of people who need some cash. And
I guess that would lead me to my final question. Should they be able to draw the full $5 million, which we don't know whether they could or not, that would push your hedge fund roughly, I think, a nudge above your 7%, right?
Well, no, because that's not categorized as a hedge fund. That's categorized as private equity, the Lexington.
Okay. So you would still be below the 7% on the private equity? Okay, I
The
got it.
only
Right.
one that we will
Okay.
be at target on right now is the commodity piece. We made a
Okay.
commitment, and I
I see
just
it.
got emailed this morning, and we haven't had council had an opportunity to review it, the paperwork on an investment in commodities with a group called Gresham Investment Manager, which is a big fund, manages about $24 billion and has, manages assets for 8 separate state funds and several other municipalities.
Okay. And my last question, and I know it's late, and thank you for the information. Lexington Partners, the company that we just spoke about here, they're the same ones that are 75 days behind in their reporting, is that correct? Or is that somebody else? Okay. So how do you reconcile in your mind doing business with an organization that's, you know, I'm not sure how big they are, or how sophisticated they are, or how late they came to the game, or how much rope we've given them since they've joined the table. I get all that. But how do we reconcile having them with potential access to $5 million of funds when they're 75 days behind in reporting and still are able to draw money?
It's a very valid question. It's one that, as I mentioned earlier, I'm meeting with them 2 weeks from tomorrow. And, you know, it's a question I intend to get some answers on.
Thank you. Anybody, Chris? I'm good. Thank you. This is good.
Just one last thing from me. This actually is a bit of a concern. Going back to the amount we have in any different class,
Yeah.
I just happen to look here in the back, your Schedule A.
Maximum you're over.
Yeah.
Yeah, the maximum. Your
Yeah.
Schedule A here,
Yeah.
your maximum domestic equities, maximum is 30%,
And you're,
and your current is 41%. That's $30+ million over.
There's a bar chart that shows that, and one of the, it shows it graphically on one of the reports we
we
gave.
know it's shown, it's a problem, is what we're saying.
What concerns me is that, you know, the equity markets could be volatile. It'd be one thing if we were to lose some money there when we're appropriately allocated. It would be probably a completely different story from our board and others if we lost a lot of money and we were really dramatically over our guidelines. I think that probably should be yesterday's business.
Yeah.
And that's the area which we would, you know, tend to, and again, I say, I think my frustration with the former consultant was moving this stuff, and I
Yeah,
think as
but
Bob
Paul,
points out.
but that doesn't, they work for you. I mean, you can't, we
True,
can't
but
blame them.
I think it's a combination of two things. They work for us, but the irregularity of our meetings didn't help that also. And I think, you know, that we're on a regular schedule, and I think when we come back here in you know, 3 months, 6 months, you're going to see this buttoned up significantly tighter.
So, okay, so we'll be seeing you, I guess, in January, right? Or this board will be seeing you in January,
Right.
maybe, perhaps
And I
somebody else.
remind you, and I will send the notice out when I send the notice out about the November 15th meeting with the actuary and Columbus Circle.
Yeah. No, but I have to agree with, you know, some of the commentary around this board. I commend you guys. You guys work very hard, and I know you're having regular meetings now, and I know you've adopted a new policy, and I've also known that you've had to swap out, both you made the election at one point to swap out the advisor, and they elected last time to swap themselves out by merging. But I do, if I hear it correctly, if I can summarize correctly, I look forward to when we're closer to the policy that you all have established. I mean, it's your policy, and I look forward to the time when we're here and, you know, you guys can sit there and say, we're within every policy limit that we have, and we're set.
It is not an excuse, but we have had 5 advisors in 6 years, and any model would tell you that's not a good model to have. We've been fortunate, the returns have been good, but hopefully we have, I'm speaking for myself, and Bob can certainly, I've been very impressed with the work so far that Callan has done, which has been outstanding, I think.
Well, thank you for your
I think in
time.
addition to that, just to add on, I think the talent on our board has changed a lot, quite a bit. the knowledge and expertise that people have has really added a lot. And so, I think you can count on that continuing.
Great.
Yeah.
Well, thank you for your time, and thank you for coming out on Wednesday evening. Mr. DeWitt, please. Yeah, I'm sorry.
One quick question, because we always debate this at budget time, and Mr. Brockfield's always leading the charge. So in January, will we have a target for budget time? Our 8%?
Well, that's what we were talking about. They're not going to have it by that
I
point.
think
Won't have it by January.
No, they're just going to have
We haven't set the calendar yet for January.
Wasn't
I would
intended
say
this
this,
way.
we would have it, we will have it in advance of starting budget deliberations, and I think
And
You
it'll
know.
be factored into the,
Dave and Doreen are going to need it for their budget, too, because it's a big number in the Board of Education budget.
All set, Mr. DeWitt? Yeah. Great. Everybody, thank you, gentlemen. Appreciate it.
Thank you.
All right, item number 2, to hear a report on the status of the Board of Education. It should be, it says the Board of Education budget, it should be actual versus budget as of September 30th, 2011. I know Dr. Title's here, along with, I wanted to say the name right, Doreen Munsell, who's, did I get the last name right? Did I say that? All right. Business manager for the school district. If you guys could come on forward, we'd appreciate it. This is great. We've got a new report here to take a look at, a quarterly financial report, which we greatly appreciate the improvement and the time and the effort on this. Could you guys briefly walk us through what your intent here is and what you're doing, and we'll go from there.
Thank you.
Welcome.
Yeah. As I said in the report, this is a preliminary report, being that we've, July, August, and September is the period it covers, and we've only been in school a month during that time frame. Just to summarize a little bit, at that point in time, we had expended just slightly over $17 million, or 12% of the budget, and encumbered a little more than $95 million, or 65% of the budget, for a total of 77%, $112 million. I went through the 7 categories that the Board of Ed breaks down the budget into: personnel, benefits, pupil services, school and support, maintenance, and capital. I went through the dynamics of each of those categories. Salaries we encumber up front as they're known. There's some part-time hourly people that we can't encumber because by their nature, we don't know until the expense occurs what we're going to be spending. And, as time goes on, we'll do another projection in January. As of December 30th, we'll have a little better idea on some of our tuitions, start to, the non-public tuitions, special ed. We'll have a better idea, although we won't have, obviously, final numbers, but that's about it. I think I explained in the text, what each category was.
Okay.
And
S-
that's about all there is right now.
So the Board of Education budget book, the opus, you guys put into 7 discrete line items
Right.
for purposes of quarterly reporting: personnel and fixed charges, pupil personnel costs, school expenses, support, maintenance and operations, and then capital items. And then you're reporting out, how often do you report out to the Board of Education on that?
Quarterly.
Quarterly. So we're going to get the same report that they get.
This is the same exact report they got at their meeting.
Okay. And the goal of the report is to be a discussion of variances, or where you stand year-to-date, problem areas. What's the goal of the report? Are there action items that come with the report? In other words, what's the expectation of the report?
Well, the numbers are self-explanatory.
Yeah.
The goal is to explain anything that we might see coming down the road,
Right.
Explain what may not be obvious, such as encumbrances, that might not be there, what we might think might happen with transportation or special ed, that kind of thing.
But is there any, how closely does the Board of Ed monitor this? I mean, as far as I can tell, they weren't getting reports like this in the past, Dr. Tittle, correct?
Right. We started this last year, I think it was after the third quarter, maybe,
Right.
and I believe you all got a copy of that. This was the same format we used last
Right.
year. We described the 7 categories, the headline categories that Doreen went through, but then, of course, under each one, there's a lot of more detail. So the Board of Ed gets it. We do a report, the board asks questions, but there's no action. One of your questions was no action items until we get toward the end of the fiscal year where we have to make transfers between line items as required by the board's policy and by the law. That usually happens in May and then in June, and then sometimes it has to be cleaned up even in September, kind of like what you're doing.
Right.
Because the state has requirements about that. The board has to actually approve transfers. But at this point in the year, second quarter report, there's no action that we're looking for. This is where we pick up on things like, last year, we got, halfway through the year, we were looking at a pretty sizable problem with special ed
Right.
tuition. Remember that whole
I do.
scenario last year? And actually, were some headlines around that issue. And so we're just trying to do this on a quarterly basis so that everybody knows that if there's an issue, we're on top of it, and the size of the issue that might be there.
Do you see any issues right now, cutting to the chase of the report right now? Or is there anything that's concerning you? I know you just started the school year a month and a half ago or so, but is there anything right now?
Do I have any concerns that we?
Yeah. Do you have any areas of the budget that you're concerned in right now?
No. We're looking at transportation. The information that comes in right now, we're just, the routes have gotten established and started, actually running, and we're looking at that, and that's slightly over, but that's not a concern right now.
Special education, if you recall, from the budget, because of the shortfall that previously had been covered by grant money, we did sizably increase that line item
Right.
in the budget for this year. So we anticipate that we've taken care of the vast majority of that. That's a very volatile account. And therefore, it could look good in October, it can look good in January, and it can blow up in March. So that's always volatile. We'll never know what that's happening till we get to May. Then we can sort of exhale a little bit. And the other wild card on special ed, and one of the reasons we do this report is to track this, is that special ed will start to show a deficit because we do net budgeting, net of the excess cost.
Right.
The excess cost money doesn't come in. First payment comes in March sometime, February? February. So people start to see us going in the red on special ed tuition. One of the reasons we do this and explain it and do a text is so people can say, well, remember, this doesn't have any excess cost in it.
Right.
We anticipate the excess cost being X, so we're really okay in that account. And that excess cost is subject to legislative approval every year. It's a big political football in Hartford. So that's a bit of a wild card. We don't know the first thing about utilities right now because we haven't even started the heating season.
Right.
We know what we're going to pay per unit, but we don't know how many units we're going to use. So this is very early in the game for us. I think this is the best way to put it. We anticipate doing this, each quarter on a regular basis to the Board of Ed, and then as soon as the Board of Ed gets it, then it would come to you in time for your quarterly. It should work out in the same cycle.
Just a question, though. Do you internally within the administration track it monthly? So if there's a problem that comes up before the end of a quarter, you could flag it? In other words, we're not beholden to the quarterly reporting if a big issue comes up. Is that fair to say?
I approve all requisitions that go through the system. and
God bless you.
expenditures. And I get reports weekly.
Weekly. Okay. Is there, Mr. DeWitt?
Thank you, Mr. Chairman. One, I'm very happy to see under the capital line, the $450,000 coming out of technology.
We promised.
You did. When are we going to do that?
It's done.
Oh, it's done. It's not.
October.
Fourth. It was
October
done on the
4th,
4th.
it moved.
Ah, great. How are you doing on revenue?
Revenue such
Your
as,
revenues, your grants, how we're paying for some of this stuff?
oh, the revenue is pretty solid. The one question mark is on the federal level. The federal government has been operating on continuing resolutions now for quite some time. Some of our Title I grant, for example, could be subject to like a little rescission. We're talking about 1.5%. So nothing that's going to break the bank, but it could be that we may get 98.5% of our revenue on that line. The biggest transfer from the state is ECS, and that goes directly to you now. We don't have to worry about the split of that. That really looks safe. You know, I really think, you know, the governor's made a commitment to that, the legislature has. So at this point, I don't anticipate any significant problems on the revenue front, do you?
Excess cost won't even, which we get in February, the first cut in February, that's based on information that's filed in December by pupil services, so we're, you know, we're not even there yet. That's an
I
unknown.
understand. I'm just wondering if you
Yeah, no.
heard any grant. I know we always hear every time we go to budget season, just
Right.
be ready.
Yeah.
The,
We ask you to predict what you're going to get for revenue
Right.
when I know there's no way to know that. but-
Well, what we did do in this past budget, if you remember, was we not only gave you a prediction about it, but told you exactly where we were going to spend it.
Yep.
And so we'll be, you know, we're doing that. So there's one of the areas where actually we're going to see a slight increase in revenue, which will help offset that, is the state's open choice program, in which we take students from Bridgeport, have for a number of years. The state increased the reimbursement to the receiving towns by about $500 per student. And we take 67 students. So that was sort of an unanticipated windfall. So we have a cushion in the event these other things don't come through, because the excess cost that Doreen mentions from the state on special ed, yeah, that's capped at the state level. All right, so the state puts aside $138 million for that, and no one knows what percentage you're going to get. We've been through this before, until everyone lobs in their amounts. And so we could easily be 30,000 short there, and you make up for it in open choice. And that looks like a positive sign, which we then can build into next year's budget, because we anticipate the legislature will keep that in place.
Open choice, the rate did go up, but I think enrollment might have dropped.
Okay. Well, at least the total dollars on that should be better. Right.
Mr. DeWitt, are you all set?
Good, thank you.
Sure. Mr. Bolito?
Thank you, Mr. Chairman. Just have two quick questions. I want to follow up on Mr. DeWitt's question about the revenue. One of the things that we lose track of is when we approve building projects and we're seeking state reimbursement, we don't really get a definitive answer about when the money finally comes through. Would it be possible for the future, as part of the quarterly reporting, to get maybe a list of what grants actually came through and which projects are assigned to, just for, you know, our peace of mind, knowing that we're getting the money that we're planning on coming in?
School construction.
School construction projects,
Exactly.
really handled by Paul.
That comes in our.
Okay. That's
I
good.
think
We
I
can
think
give
he
you a
could handle that one.
report on a quarterly basis as to what we received. Obviously, the two major projects that are open right now are Stratfield and Fairfield Woods. Stratfield's been coming through on a timely basis. and-
Open items versus what's,
Yeah, there's always a significant lag on those payments.
Yeah, I know. That's why it helps to keep track of it.
Witness the
because
fact,
we lose it.
and there's a backup. We are still waiting to be audited by the state on the Tomlinson project.
Right. That's unbelievable.
So
Okay.
there's,
All right, and the other question I have is that I remember from my PTA days that substitute teachers used to be factored into the principal's annual stipend. Is that still the case?
Stipend, I wouldn't characterize it as a stipend.
They might, but
Right.
their annual budget, let's put it that
Yes,
way.
you may recall that one of the changes we made in the budget construction was that the principals were all given an allocation, I guess would be the term I would use.
That works.
And that this year, and that appeared to have an adverse impact on certain schools if they happen to have teachers that got sick, that it was affecting other parts of instruction. So that didn't make a lot of sense to me, and when I asked, why do we do it, the answer was,
We've always done it that
always
way.
done it that way.
Yep.
So we changed it. So this year, it's in a big lump at the central office, and we took an estimate on what the usage would be there. Given that we're only, again, 6 weeks into the year, it's too early to say.
Right.
Think next month or two, we get a better handle on what the substitute is. We'll see how we did on our estimating there. But it is now a central office item.
Have you received any complaints or positive feedback from the principals about that? Because one of the things that I heard was good about the old system was that individual principals at their schools could have some flexibility where some schools would prefer to have more materials or more, paraprofessional help, whereas other schools would really like to put the money toward having the substitutes in reserve because, maybe they had teachers who were inclined to be out more often, I don't know, but some principals like that flexibility. What's the feedback you've gotten from them, understanding it's still early in the process?
Right. One of the things we really wanted to clean up, and we addressed with the elementary staffing model, was to come up with a standard way to assign staff to the elementary schools.
Right.
And not have it be dependent on a principal's preference for staff over supplies.
Right.
Right? And so, if you were maybe a principal who, maybe your PTA would buy your supplies for you, right? So why should you get the extra para? That didn't seem to make a lot of sense from an equity perspective.
Sure.
So we really took all of the staffing levels out of the hands of the principals, and the principals got together and decided on a staffing model that, to this point, the elementary schools are extremely pleased with. I can't tell you, every time I walk in, they're just so thankful for the
It's one less
support.
thing they have to worry about, right?
Right. Well, and also, it's an increased level of support for struggling learners. I mean, that's kind of why we're here. So there's pros and cons to this. Sometimes flexibility is good, and sometimes it's a curse.
Yes.
So we anticipate that we'll construct the budget largely in the same manner with respect to allocations at the building level this year, because by the time we build this budget, which is happening shortly, we probably won't have enough track record to say, it really needs to be changed again, so.
Okay, thanks a lot.
Any other questions, comments, concerns? Please, Mr. Kiley.
Thank you, Mr. Chairman. I'm looking at the capital line, and I might just be doing the math wrong, so maybe you can help walk me through it. The original allocation is the 1.284 million, right? The capital, right? And the expenditures to date are the 426, right?
Right,
And you have outstanding encumbrances of 153.
correct.
So that comes to 579, right? If you add those two together,
Yep,
right? What you spent versus what you've committed to. And then if you add to that the 450 that is going to come out of that line, right? Yet, because even though it's happened on October 4th, it hadn't happened as of September 30th. Would that be correct?
correct.
So when you add the 450 to the 579, it comes to 1029, if my math is remotely correct. And that coming out of your 1.284 leaves a balance of $254,000 in that account. Does that math all make sense?
Yeah, I didn't follow what you said about adding the 450, though.
Pardon?
You said something about adding the 450?
No, pulling it out. Well, adding the 450 because the 450 is coming out of that account, correct?
Yeah, you're adding it to the encumbrances and
Yeah,
the
exactly.
expenditures.
Right, right. So if I take the 426 plus the 153 plus the $1,000, and then I add to it the $450,000 commitment that we have, all that roughly comes to 1030. 1,030,000. Am I looking at that correctly?
The 450 is a budget transfer from that budget line up to the health insurance line.
Right, but it's a reduction of the line item then, is what you're
That's
saying.
what that's kind of where I'm going.
Of the budget, it's got nothing to do with the expenditures?
Understood.
Okay.
Right, but it's still part of the 1.284 in grand total from the beginning of the budget approval,
Correct?
right? So,
What you're, yeah, another way to put it, Kevin, you're right. The 703 is the net left, minus the 450.
you get to the 253, you get to
Right.
254, right, so you take
Right.
the 703 less, right, it's the same math. So I guess my question is, knowing that it's early in the year, and knowing that the one thing we know about any budget is that they're always wrong, because they have to be, right? Is $254,000 for capital for the rest of the year an adequate amount of spend to get you through the year? That's more of a question for Dr. Tittle, I guess, and it may not be answerable sitting here without the data points, and I don't remember what projects were within the original 1.284, but is it too tight? Is it not, or is it just right?
Well, the whole budget's tight. Okay.
Fair point.
Go with that.
Boy, that was a softball.
Right. Right.
I was trying to follow my fuzzy.
Yeah.
Right, exactly. The whole budget's tight. We have separately, what we've done, and we can share this with you if you're interested, we've separately tracked every one of those projects in the budget, what the estimated expenditures were, what the current expenditures were, and what we think is going to be left in there. So we believe that we will be able to do virtually all of the projects in that capital account between now and the end of the year. However, we can have an emergency, which will cause us to not be able to do something in that line. So right now, it's tight, but we're proceeding on these projects, because one of the things I wanted to assure everybody is that, you know, we gave a list of 35 projects and said we were going to do them. We want to show people we're really doing them, that they're not in there and then we're suddenly going to spend the money on something else. If it's an emergency, we have to spend it on something else. So our anticipation is, yes, we can complete those projects with the caveat that an emergency between now and May could knock one of those out of the box.
Right, and that's back to Chairman Flynn's first question. Are there any, are there any problem areas that you've come across? And, and obviously I heard the answer, and there are no known large ones at the moment, which is good news.
Well,
It just seemed like,
let's
was-
see. We don't know if the Dwight boiler's going to make it. We'll see.
right,
The maintenance projects that I think you're talking about are in the maintenance category, not that capital category.
Right. Oh, that's true. That's two separate. That's a good clarification. Right. Yeah, the,
The capital's equipment. just
Understood.
Right.
equipment. Okay.
okay, thanks, I'm good.
oh, yeah, that's true. We're talking about two different lines in the same
Right, so the maintenance.
account group,
so-
right. The
Right.
capital that was the technology
Yeah,
area, right?
right.
Right.
Thanks.
Right. So, yeah, we're fine. Thank you. Good clarification.
Well,
I wasn't referring to.
thank you. Before we move off the item, seeing no other questions or comments, interesting to point out that there's another report that you put together on the closeout of last fiscal year. And I was interested to see, we talked about the transfers at the end of the year between the budget lines, and it would appear that it was 0.42% or less than 0.5%
Right.
of transfers. That's remarkably accurate.
Right.
The transfers that we do at the end of the year on the town side. Mr. Hiller, you might
Right.
be wagered against here.
They don't have a fire department.
Yeah, to be fair about this,
That hurt.
yeah, to be fair about it, we do it within account groups. It's not every
Right.
line
Right,
in the budget.
okay.
But
It's
yeah.
still
It-
quite
It
good.
was better than we thought it was going to be.
Yeah.
And one
That's
of
what I
the,
noted, the amount was pretty small.
yes.
Yeah,
Correct, yes. Right.
it's quite
Right.
good.
And what we try to do is, whichever department is overexpending, they have to try to find the money first within their own area. So we don't have to do this.
And I
So
think-
there's no incentive to overexpend your department because you know someone else will bail you out. The first person we go to is you.
Right,
That gives people an incentive to stay within the guidelines.
right.
Yeah.
I commend Dr. Tittle and Mrs. Munsell, but I must also remind the board that unemployment compensation is 100% on the town side, and we only ran over budget there by about $80,000, or about,
Paul, it's okay, they beat you.
We should,
Just let it go.
right. And we have to give some credit to Bonnie for the controls of that last year.
Absolutely.
Okay.
Thank you very much, and thank you for the report. We look forward to seeing it on a quarterly basis. All right. Item number 3, to hear a report on the current status of Fairfield Metro Center. That would be from the first selectman. And to hear a report from the independent counsel, which is, like 5 minutes. At the request of a couple of my colleagues, let's take a 5-minute break, and we'll come back and do the reports, okay? Thank you. Everyone, welcome back. We're going to bring this back into session and take up item number 3, to hear a report on the current status of the Fairfield Metro Center and a report from the independent counsel. Welcome, Mr. Tetro.
Thank you, Mr. Chair. If I understood things correctly, to kick things off, you wanted some quick highlights as to the status of the project.
Yeah, please.
So with that as a guideline, let me step through some of the highlights that we covered on Monday night with the RTM. Probably highlight number 1, we've got a tentative station opening now for December 1st, or the first week in December. Through no fault of the town, we're on schedule with what we're doing. Through no fault of DOT, they're on schedule with what they're doing. Metro North was inspecting the tracks, came across a track issue on one of the bridges leading up to the station, and in working at that, identified they're going to need another 2 to 3 weeks to finish that up.
Can I ask a question on that?
Yes.
Because I read that in the press as well. Trains are running through the station, but just not stopping at the station now, correct?
Correct.
How do they do that if there's a track issue at one of the bridges?
As a former commuter, let me step you through that.
Yeah.
There are multiple tracks.
And I'm a commuter now, so
Okay.
please do.
Well, generally, it's in your preference, I suspect,
Yeah,
to step onto the train when it's on the track closest to the platform.
yeah,
Occasionally, when that track isn't available, they'll bring out temporary bridges,
right,
all right, where you can step across those to an interior track.
right. So that's what they're doing now.
They didn't want to open the station using bridges to the interior tracks.
Okay. Okay, thank you.
Going to jump ahead quickly to the expense summary. It shows that we're still on track overall for $45.2 million in total project costs. We've got about $8.2 million to continue. Now that, the $32.6 million for the Fairfield Metro Center, those construction costs are as of 9/17. So that's one change in this format that's different than the prior reports. In prior reports, we've had a clean month cutoff. We didn't have the full numbers for September, which is kind of normal at this point. So rather than giving, but we had solid numbers through part of that, so rather than giving the numbers through August 31st, we gave them through 9/17.
Okay, so run through that again real quick, please.
Sure. If you want.
Yeah. Is it?
I think that's the legal analysis.
No, that's the legal. Here, Mike, I'll help you out. Asking you to see.
Yes, sir.
Mike, I'm sorry, what page are we on?
Page 11.
So the expended to date is as of 9/17 on this?
Correct. If you turn back to page 7, you'll see that footnote at the bottom.
Okay. Go ahead. then.
So back, basically, as of 9/17, we had $8.2 million to go. If you look at that in terms of the additional expenditure, we had about 7.5 approved in addition, and we were shooting as of a 9/15 date was what we were worried about, kind of coming to an end of our money. Because of the hurricane and because we were able to manage that slowdown, this shows that we had about $800,000 left on or about 9/15. The intersection improvements are down to about $100,000 to go there. That's a lot of paperwork and punch list items on the intersection improvements. And then just flipping ahead to the last page, page 13, to look at the work status and accomplishments. The paving and striping on the commuter parking lot are completed. Paving of the access road are completed. Those were the parking lot and the access road were the two big things we needed to complete by 10/31 per our agreement. I talked to the Commissioner of DOT today, and he is in agreement that we met our requirement of being substantially complete by that point. If you go through, there's some punch list items that we still have to finish up, and I'll step through a couple other items here. All the utilities are installed, and by that I mean the utility structure. The conduits for the lines, that type of thing. The water main is being pressure tested. UI is scheduled to pull the wires through the conduits later this week. Excavation of casting sands along the shoreline is complete. Excess soils are being screened and placed under a liner on site to the extent possible. Options for remaining material are being evaluated. We had talked about 12 to 15,000 cubic yards of excess soil. It actually came out closer to 25 to 30,000 excess yards. One of the things we were able to do is go back and literally screen a lot of the rock out. So then you're only having to dispose of, if you will, the soil. We're able to crush the rock and use that in other places on site. When it's all said and done, we'll still have to move some soil off site, but we managed to store a lot more of that on site than we had originally anticipated.
Will that lower the cost to complete?
No, because we had so much overall excess soil. What it does is keep us within the budget we have now. We think we can still finish everything within the dollar amounts we've requested.
But I thought some of the cost was to cart some of it away.
It is, and we'll still have soil to cart away. We went from 15,000 total cubic yards to, let's say, close to 30,000.
Okay.
We managed to store a lot more of that on site.
So you came
So we
bridge back
still
to
have,
15.
yes, so we still have a certain amount to carry off-site, probably in the 9,000 to 10,000 cubic yards at this point. What we're looking at is primarily a wash. We save money in terms of transportation costs. We did incur some money in terms of crushing the stone and screening it and storing it on site. We have less to carry off. So far, it looks like that's a wash, so we're not seeing any reason for concern there at the moment. The supplemental grant agreement with the state, that's the agreement that would come back through the Board of Selectmen, this board, and the RTM with the agreement for the $3 million. We've been following up on that every week. The state's been telling us it's going to be here every week. According to my update phone call today, we may have a copy of it by the end of this week.
Is there a concern that that's not going to happen?
No.
Based on what? Why are we so confident that that's not going to? What's causing the holdup?
DOT attorneys, and the fact that they're also negotiating the UI DOT agreement on the
Same
easements.
group?
There's only so many attorneys they have, and only so many get assigned to our account, for lack of a better term.
When did they tell you it's going to be complete?
By the end of this week, but I've heard that before.
But you don't have a concern that that's not going to happen?
No, my phone call today was directly with the DOT Commissioner, Jim Redeker.
Yes, Mr. Polito.
Yeah, on that specific issue, you presented a memorandum of understanding before the boards and bodies throughout the process. Is the contract going to differ significantly from that memorandum of understanding? What's your take on it?
It shouldn't. You know,
So-
that was part of my call today, was saying and confirming that we're substantially complete, and that meets the requirement that they were looking for. They had toured the site last week. I had a chance to tour it today. It looks in great shape, dramatically different than any of the tours if you've taken them earlier in the year. We hope to have the contractor do walk through and kind of develop a punch list next week.
Right.
So we still have a lot of finish-up work to do, and certainly some mitigation work to do, but the work on the roadway and the parking lot, it's looking very good.
I just don't understand the holdup, because you're saying that we substantially completed our obligations as were contemplated by the memorandum of understanding. The agreement's already been drafted, at least in that form, so it's really incomprehensible to me how that could be taking so long. Some of it, I guess, is just the fact that it's state government, but I don't understand the delay. You mentioned the fact that they're working through the UI issues. That was easements through the parking area? That's what's still outstanding with them?
Correct.
But they're pulling the wires this week, I guess, because it says the 24th. When you say they're pulling the wires, is that underneath or above?
Underneath.
So they're pulling the wires underneath, but there's some disagreement about the easements underneath.
There are several different easements that we're talking about.
All right. But it is UI still. So where they're pulling the wires, you're saying, is not the subject of disagreement between UI and the DOT?
Correct.
Okay. What are the easements that they're disagreeing about? What else is there?
There's additional easements that go from the, let me see if I can catch all these. There's one set that deal with going under the parkway, or under the parking lot, to a transformer and panel set for the state and the town that will power the, or that will provide the power to the parking lot. And there's a separate panel off of that, which is another easement, which goes to a panel that will provide the power to the roadway.
Okay.
In addition, there's another easement that goes to another transformer that will provide the power to the concourse building for BlackRock Realty.
Okay. So it sounds like what we're talking about is the purpose of each set of wires, correct? So obviously they're pulling some wires. Do we know what those wires are going toward? Is they going to the transformer, the concourse, the other transformer?
They're going to the power to power, or going to the transformer that will work the power, the parking lot.
The parking lot, okay. So that leaves the roadway and the concourse building. And that's what the dispute's about?
Concerning the easement and the placement of the, yes.
So it's a matter of where they're putting it. That's what they're basically arguing about. It's not the fact that they need to get under the roadway to provide access for the lines. It's where it's going.
Right. This is not under the roadway. It has to do with the land itself, because we currently own the parking lot. Because we'll be transferring that to the state.
Right.
We could sign off on it, but we want to make sure the state agrees to the contract or the easement, so that when we transfer it to the state, they're okay with that.
But again, it all seems to come down to location, because if you're talking about essentially 3 sets of wires going to 3 different places, one of which obviously everyone's agreed upon because you pulled the wires this week. So again, what's the hang-up with the other 2? That's the part I'm not getting. Maybe I'm just missing it.
It's the, let's see how I can simplify this for you. It's agreeing to the location of the easement and the wires and providing the power to the concourse building. There are a couple different options. UI, there's kind of one that UI has agreed to and was planned on. There's also some options that the state would prefer. So that agreement is what's getting worked out.
If it's underground, who cares? I guess that's the part I'm missing. If it's underground, what difference does it make if it's over there or over there? You know what I'm saying?
Yeah. I really wish you worked for the state so that we could have that conversation, because I agree with you.
I know you'd like me to work for the state, but it must be exasperating. I mean, it's exasperating to us because, you know, this is something that should be kind of done already, and it's endlessly held up for no good reason that I can see. All right, move on, sorry.
Thank you. Any other questions, comments right now on this? Seeing none, thank you, Mr. Tetra. I appreciate your time tonight.
I'll turn this over to our legal counsel who evaluated the contract approval process.
Yes, thank you. Good evening,
Good evening. Hopefully this works.
and I'll get out of your way.
That's it.
Gentlemen, could you please lower your microphone?
Yep. You've been wanting to say that for a long time.
Please lower your mics.
I think shut off is the actual.
All right. Good evening, Mr. Chairman, members of the committee. I want to introduce myself. I'm Rick Reporter in English, and I've done this presentation twice, and each time it gets better. So I have to change the jokes so the people from the press who have been here for a few of the sessions don't get bored and gloss over. In any event, let me start off by saying that our firm was retained by the town of Fairfield, as you know, to conduct an analysis of the actions of certain town officials with respect to contract approvals for contracts related to the Metro Center project that were entered into purportedly by the town and its former first selectman and board of selectmen in the spring of 2010. In performing our analysis, we reviewed several, actually, why isn't this going up on the screen here? I have no PowerPoint up on the screen. Is this the old Control F8? Function F8 again?
Projector is off.
Oh, okay.
Yeah.
Well, that's the part that I forgot to do.
That's okay. We love you.
You didn't stop me before, I didn't even realize it was off.
It takes a second to heat up.
Okay. Okay, I'll start going through the first part of it, and we'll catch up on the slides in a moment. The sources of authority we analyzed were the 2003 agreement, which we refer to in our report, which I assume that the members have received, as the tripartite agreement. It's an agreement between BlackRock Realty, the state of Connecticut, and the town of Fairfield regarding the original scope of the project. In our report, we see that there seems to be no dispute from anyone involved, including the officials and the town attorney at the time, that the charter was followed in 2003 and that all necessary approvals were obtained with respect to that original agreement in 2003. Namely, there was Board of Selectmen, Board of Finance, and RTM approval sought and obtained prior to the agreement being entered. In fact, the agreement itself in 2003 was conditioned upon the obtaining of all three approvals, and there was even, I believe, zoning board approval as part of the process, although it wasn't required as a condition of the contract. It was mentioned and it was obtained as well. There was a 2003 resolution that went through the Board of Selectmen and was ultimately approved by the RTM, and I believe went through this board as well, that gave the first selectman certain authority with respect to administering the tripartite agreement. And the tripartite agreement at that point was defined to include more limited obligations of the town than the current 2010 agreements that I'll discuss in a little while. With respect to the tripartite agreement, the 2003 agreement, there were, as part of this resolution, very specific appropriations made for the town to fulfill obligations under the agreement. The first of which was a $6 million bond issuance and proceeds therefrom that was to be used in furtherance of the project. And the second was $4 million in federal grants that had been received or being held by the Department of Transportation at the state level that were to be made available to the town of Fairfield on a reimbursement basis for use on the project. And there was an authorization as part of the bond resolution, in the resolution in furtherance of the agreement, that authorized the first selectman to spend money against the $4 million sums as well as the bond proceeds, knowing that the $4 million in funds would be reimbursed by the state. So it allowed that expenditure against that $4 million amount that was to be 100% reimbursed. Again, as I stated before, the agreement was conditioned on obtaining approvals from various boards, including this one. And the town's obligations with respect to the project were limited. The town essentially was obligated to perform construction and development of the parking area that was ultimately going to be turned over to the state. There were some remediation obligations in the agreement. Those were also specifically set forth. And there was a cost sharing between BlackRock Realty and the town of Fairfield with respect to those, and there was a sharing of that obligation financially. There was obviously the 2003 resolution authorized the appropriations that I described earlier. Now, to do the analysis that we did, and our report sets forth the analysis in some detail, and I'll answer questions of the members as we get closer to the conclusion, or if at this point you have any, I can go through those. But basically, we looked at the town charter principally. Our law in the state of Connecticut provides that the town charter is really the source of all municipal authority, but the charter also exists in the context of state statutes that govern municipal powers as well. So we looked at both of those, and we tried to make a common sense reading of all of those statutory provisions as well as the charter itself to come up with an understanding of how the charter was to work together with the state statutes and how it would logically be interpreted. We concluded as part of our analysis that contracts must be approved by the Board of Selectmen. I think there's no question in the charter that expressly states that the Board of Selectmen would be the body that would have to approve all town contracts. That approval authority, as we'll discuss in some more detail, is not an absolute authority. The fact that it is authorized and empowered to approve contracts does not dispense the need for review and in some cases approval by other town boards. The charter itself also has a provision, it's section 12.7 of the charter, which forbids expenditures and excessive appropriations for a specific purpose without the approval by the Board of Finance and, if appropriate, transfers within the budget if you're in the course of a budget year. And finally, there is a requirement that under the town charter, both in terms of the annual budget and at other times as well, that the RTM must approve appropriations that are being requested by the various town officials or boards, and that's built into the charter as well. The part of the charter that discusses the powers of the Board of Finance also incorporates by reference Chapter 106 of the charter, which generally describes the powers of boards of finance as well, and we thought that was a relevant place to look because not only is it part of the state law, it's also incorporated directly in the charter. One provision of that chapter of the statutes, they call it 106, but they codify it as Section 7 of the statutes, is like 12.7, and it prohibits making expenditures and also entering into contracts that would require expenditures beyond appropriations. And so we looked at that part of the statute as well. We also looked at the following chapter of the state law as well, which is in or about 7-359, which deals with the creation of special capital funds as part of our analysis. In summary, this is how we concluded the law to work together. First of all, we concluded that the Board of Selectmen must approve all contracts. And there's an exception to that rule. If contracts are less than $10,000 in value or in revenue to the town and are less than 1 year in duration as far as what they're contemplated to, how long they're contemplated to last, and the obligations of those contracts, the Board of Selectmen can delegate its authority to a town official to enter into contracts under that value threshold and that duration threshold. We concluded that this small purchase threshold didn't apply to the analysis, but it was something we wanted to note. The Board of Selectmen's contract approval authority must yield, we concluded, to prohibitions on expenditures and excessive appropriations for a specific purpose. that they needed to act together with the other boards in town to ensure that if you were going to obligate the town to take on expenditures in excess of appropriations, there needed to be some role in the other bodies. And if appropriation is required, since a contract would require the town to expend in excess of existing appropriations for a particular purpose, we concluded that the Board of Finance must approve those expenditures, and if necessary, the RTM would approve the expenditure, especially in the case of large amounts of money. The 2010 agreements that I referred to earlier are essentially two agreements, and I referred to these two as the 2010 agreements. There was also a third agreement called the binding letter agreement, which I'll get into. It has to do with certain revenues that were to come back to the town over the course of the operation of the train station as well as its commuter parking lot, but I'll deal with that separately. But when I talk about 2010 agreements, these are the ones I'm talking about, namely a letter that was entitled the clarification letter with BlackRock Realty and the state-town agreement. In analyzing these two agreements, we concluded that these two agreements together were intended to modify the 2003 tripartite agreement, which the original 2003 tripartite agreement provided that it could be modified by a writing by all three parties. We just happen to have what we observed are two separate agreements between the contracting parties. The net effect of these was to modify the tripartite agreement, even though it was done in two separate instruments. And in observing the terms of the 2010 agreements, there were some notable expansions of the town's obligations under the project. Most significantly, the town was to take a more managerial role over the general construction on the project, on the public portion of the project, aside from what the state was going to do on the station itself, essentially. And there were more and enhanced obligations with respect to remediation. The agreements also obligated the town to spend money without an appropriation. In other words, unlike the 2003 agreements where there was a resolution that set aside and specifically allocated and designated $10 million to the cost of the project, the 2010 agreements did not do that, but it did obligate the town to spend money against some funds that were made available by the other contracting parties. Specifically, the state was going to make available $19.1 million under these agreements for the town's obligations, expanded obligations under the agreement, and the state had certain protections with respect to the 19.1. First of all, it would pay the town on a reimbursement basis, and if the town did not fulfill its obligations with respect to its obligations under the enhanced agreement, it had the ability to claw back the money, the 19.1 million. It also had an obligation for the town to complete the expanded obligations on the project at its own cost if the cost of performing its obligations actually exceeded the money that was made available from the state. There's 19.1 available from the state and approximately $5 million available from BlackRock Realty. And so if the town needed to kick in extra money, it was going to be obligated by these agreements to do that. So those were some financial obligations that the town undertook with respect to the 2010 agreement without a separate appropriation. The agreements, the other agreement that was entered in 2010 postdated the state-town agreement, but was an agreement between the town and the state of Connecticut DOT regarding parking revenues. What this agreement did was it modified the formula for computing the town's share of parking revenues for the surface parking area. Essentially, the 2003 agreement provided that the town would get the first $300,000 after the state paid it itself for its actual operating and maintenance costs for the surface parking area. And so that was the original deal. The binding letter agreement provided that the town would still be eligible for the $300,000 in revenue. However, the state would be able to take account for its operating and maintenance expenses on that area, on the parking lot, as well as would be able to take credit against the what they call the principal on its bonding obligations that were related to the $19.4 million that it made available for the project, $19.1 to the town on a reimbursement basis. So essentially, over 20 years, they charged the town a level amount of $1 million, which it would receive from parking revenues before in addition to operating and maintenance expenses, before the town would get $1 up to the $300,000. The binding letter agreement, unlike the 2010 agreements that I described before did not follow the same process. The 2010 agreements that were approved, unlike the 2003 binding letter agreement, were approved in the first instance by the former first selectman, and then they were submitted to the Board of Selectmen for approval. And the approval was obtained after the former town attorney had given an indication that the approval was not necessary because the first selectman was authorized under the terms of the original bond resolution, in his view, to enter into the agreements. But there was a ratification of the first selectman's actions to approve the agreements with respect to the 2010 agreements. The binding letter agreement, however, was not approved by the Board of Selectmen ever. It was not submitted, and to our knowledge, wasn't disclosed for some time following the approvals of these agreements, and maybe even as late as 2011. So there was never a Board of Selectmen ratification of those agreements or submission to any other town bodies. Our conclusions were that the charter required the same approval process as in 2003, namely Board of Selectmen, Board of Finance, and the RTM. And we did that in a reasonable reading of essentially Section 6.1 of the charter, which deals with the Board of Selectmen's approval powers, as well as the sections that deal with the Board of Finance authorities under the charter, Section 12.7 of the charter, and the rules regarding the RTM in terms of appropriations. We concluded that the former first selectman himself was not authorized to execute the agreements in 2003 pursuant to the resolution in 2003 or the charter. And we based that on what we believe to be a reasonable reading of both of those to not give the powers. We believe the resolution gave certain authority, but that authority was limited to administering the obligations under the 2003 agreement. We also concluded that the 2010 agreements required appropriations. They actually obligated the town to commit to appropriations. And we also concluded that the Board of Selectmen could not obligate the town to spend sums above the 2003 appropriations for the project because they were set aside in a special capital project, and the town should have gone through the process of having the Board of Finance and possibly RTM as well be involved in the approval process. And the binding letter agreement was never submitted to the Board of Selectmen or disclosed to other town bodies. We were asked by the town to, or by the first selectman, to provide an analysis of individual liability issues potentially. And what we did, as we looked at this, we did find that the state law and charter forbid officials from expending money in excess of appropriations and does allow for the town to recoup money from individuals, but with certain exceptions. And the exceptions are not from a lower court decision. The exceptions come from a Supreme Court decision, which we cited in our report. And essentially, what the exception provides is if a public official makes expenditures that are in excess of appropriations, is prohibited by, Section 7348 of the statutes or the analog in 12.7 of the charter, there is an available defense if the expenditure was for a public purpose. And in this case, it was for the benefit of the train station. Clearly, I think you'd have a hard time arguing that it is not for a public purpose, and we would conclude that it would be for a public purpose. That the town enjoyed fair value for the purchase. And again, we think that there's a strong, very strong argument, obviously, in favor of the town having a fair value for the purchase. It will have a train station, and that could likely be proven. And that the official did not receive personal profit. We noted on that prong that there was an investigation by the town's auditors into whether or not there was anything of that nature, and there was no finding that any public official of the town or board personally profited from the entering of the 2010 agreements in any respect, and that the source of authority is ambiguous. We came out in our analysis with a conclusion as to what the charter and state statutes operating together provided for. We don't believe there's ambiguity there. We stand by our conclusions that that's the proper reading of the charter. And so, as you'll see there, we believe the first three elements of the exception were met. The fourth, for the town officials who actually paid money in reliance on a town attorney opinion, we think that because the Supreme Court has been disinclined because of countervailing considerations. I mean, on the one hand, there's clearly a legislative in charter policy that prohibits the expenditure of monies beyond appropriations, but there is a presumption in favor of public officials who sometimes serve as volunteers or sometimes serve in the public sector, where they might also go to the private sector and make out better financially, that they should not be lightly found liable for expenditures unless, obviously the 4 exceptions to the rule are not met. And we also concluded that the harm to the town would be difficult to prove, that it's very possible, based upon the climate of the town, that the project would have been completed anyway, and it's very difficult to identify a specific harm as a result of the actions of the town officials from a financial standpoint. And with that, I'll ask the chairman if any of the members have any questions for me. I'd be happy to answer them.
Can we turn off the overhead
Sure.
blinding light?
Is that a function F8? What's the,
I like the silhouette comment.
We don't want to have a seizure.
Trying to find
I thank you for the presentation. We'll go to questions from board members. Mr. Bolito?
Thank you, Mr. Chairman. On page number 7 of the back part of your report, not the executive summary, but the actual meat of the report, all right? Section B, Board of Finance.
yes.
You note in the last paragraph, the language of this charter section does not expressly cover the action of entering into a contract which might obligate the town to incur expenses beyond appropriations, although, when read with Connecticut General Statute Section 7348, it may be fairly read to impose such an obligation. What you said was that if there is an appropriation made, that the Board of Finance should get it. But here, there wasn't an appropriation made. There was just the possibility that an amount may be appropriated. Does the charter provision, in your mind, make it crystal clear that the possibility of future expenditures should make it come before this board?
That's my understanding. I think that when you read 12.7, and there's a prohibition on making expenditures that are beyond appropriations, if a contract obligates the town to obligations that could reasonably lead to expenditures, the Board of Finance is the body politic that has really the jurisdiction to decide what the appropriation should be. It could be that they may decide there's no appropriation needed, but it should go to the Board of Finance based on 12.7.
Now, in the agreement that was entered into last year with the state and BlackRock Realty, the state of Connecticut put $20 million in, basically on a reimbursement basis. So could an argument be made in a court of law that it's really not a new appropriation? Basically, the state of Connecticut has made that money available. There's no real appropriation to be made by the Board of Finance.
Well, I believe that would not be the correct interpretation, and the reason being, if you're going to be reimbursed you're going to seek reimbursement from the state of Connecticut, just like you did in 2003 with the $4 million that was available through DOT from the federal grants.
Mm-hmm.
You're putting money out there in play with an expectation that you're going to be reimbursed, but you don't know whether you're going to be reimbursed until you actually get reimbursed. And if you look at the way the contracts are written, the state had the ability to decide whether to pay or not pay. And there were certain obligations relative to the BlackRock money that was similar, where you had the certain obligations of the town regarding the project had to be satisfied in order to be able to get the access to that money. It was held in escrow. So you're putting money out with an expectation you get paid, but it's not a certainty that you're going to be paid. So in the immediate term, you are expending money, expending money clearly in excess of appropriations. There was no appropriation ever made for the 19.1 million as there was for the $4 million.
Right.
And that's the, at least in the immediate, that's the sort of the short answer to the question.
Right. Okay, fair enough. Now, in terms of the damage prong of that the Supreme Court case, where you said that, in your opinion, the town, it cannot be reasonably proven that the town did not suffer damage. What about the fact, playing devil's advocate, that were it not for the existence of that 2010 agreement, that the cost overruns would not be the responsibility of the town of Fairfield. That under the terms of the 2003 agreement, we had specific obligations which were met, and we would not have been responsible for cost overruns had that agreement been in effect. Isn't that real damage?
That could be argued as a measure of damage, but there's a causation aspect as well. You know, would the damage have been caused irrespective of the entering of the 2010 agreements? Namely, would those agreements have been entered into anyway? Would the project have proceeded with the same scope that it ended up proceeding under with respect to those 2010 agreements? It's very possible that that could have happened as well.
It's possible it would have proceeded, but the responsibility for payment would have been different, because under the terms of the original agreement, the town of Fairfield was not responsible or liable for cost overruns. So the 2010 agreement changed that fundamentally. It put the town squarely on the hook for cost overruns. So to say that it would have proceeded that way anyway, I don't think that follows, because you're changing the responsibility, the legal responsibility for making that payment from the state or BlackRock Realty to the town of Fairfield. So in essence, that agreement is causing real damage.
I'm certain that both sides can be argued on the issue of damage. It's knowing what it would take to persuade a court of law, especially in light of the presumptions that this would be actual damage and that this would be a causative factor. They would look at a number of different factors. They would look at, you know, the climate in the town politically. They would look at the meeting videos. They would look at the minutes of the meetings with respect to the project. As we pointed out, we had concluded previously through my partner, Mr. Fisher, who came before this board as well, that the agreements themselves, you know, at this point, we concluded that they were enforceable. And
I got that part right.
The reason why we had concluded that was because the agreements themselves had gone through the various boards and commissions in 2010, very soon after it had been approved by the Board of Selectmen. And those types of arguments, that why was there no protest at the time, that or call, you know, to stop this process, there's always that argument that because of the silence of the boards and commissions in the fact that there's enough there to ratify those contracts, notwithstanding the fact that the approvals weren't obtained, that those would have gone through. And I think that's a compelling argument.
Well, except for the fact that there were members of this board that certainly raised questions about the agreement when it was presented to us last year. And I know for a fact that there was an RTM member who specifically questioned about the parking revenue and about the shifting of responsibilities. So, you know, in your estimation, would those facts be persuasive to a court in terms of figuring out that prong?
As far as the parking revenues are concerned, I'm not aware if the parking revenues were ever made, that binding letter agreement was ever made public or
It was.
made known until at some point after the fact.
It was made public here, in fact. Yeah.
But it was sometime after the fact. It wasn't in the May or June timeframe of 2010. Is that accurate?
I think when we got the report from former First Selectman Flato last year, we got a copy of the agreement, the I guess you're calling it enhanced agreement, and the parking revenues, I know I mentioned specifically, so we must have had some document in front of us, or Mr. Flato might have offered that via his oral testimony here, but it certainly was before this board at that point as an informative report rather than something that was a voting item for us. But in any event, moving on to one other item, you mentioned specifically that you felt it would be difficult to prove or make out a case to find former First Selectman Flato liable in his capacity as a public official because of the high threshold set forth by the Supreme Court decision. I did not see, and maybe I just missed it, but I did not see any opinion as to action against former town attorney Saxel via legal malpractice. What is your opinion as to that potential avenue for recourse?
Obviously there's the same. Attorney Sachs will be acting as a town official. He would have been designated as a town official under the charter. The issue of legal malpractice is a complex one as well, and one in which there's a certain level of proof that you'd have to to be able to muster. We have not formed an opinion as to whether or not there would be any legal malpractice. We were asked in earlier boards, but we don't have an opinion as to that.
Why not?
We just haven't been asked to render a formal opinion.
You did find, though, that both former First Selectman Flato and Town Attorney Saxel bore some responsibility, or bore primary responsibility for the agreement, correct? You named Attorney Saxel several times in the report. Is that accurate?
Well, let me parse your question. We did identify the statements that were made by Attorney Saxel with respect to the approval process, and that was relevant to our report and our analysis so that we understood what the basis was for the contention that these agreements were approved appropriately. So we follow that lead. So we did mention that in the report, and we also mentioned former First Selectman Flato's actions as well, because it was relevant to examining those actions to see if those would also complied with the law. So we looked at those and we tried to articulate what their positions were in the report so that we were able to compare those as against what we believe to be the reading of the charter and the ordinances. So we did include those in the reports. And again, we did look at the individual liability issues generally with respect to the Arminio case, and we did put our conclusions out there. And I think the same rationale would apply to examining actions taken by either, because with respect to a malpractice case, from what I understand of malpractice cases as well as town official liability cases, there's a need that there's a causation, that whatever was done caused the ultimate harm, and that there was harm to be proven. And again, back to our earlier discussion, and obviously you're certainly entitled to your opinion as to whether or not you believe there are countervailing considerations.
Sure, understand.
But as we had come out in our conclusions, that those two would be difficult to prove.
But with respect to the fourth prong of the Supreme Court case, didn't you say that the reason that the authority was considered to be not ambiguous, in your opinion, was because of the fact that the First Selectman relied upon the opinion of the town attorney, correct?
Well, the ambiguity, I did say that in my statement. Ambiguity and whether someone should be held accountable, they're related. Obviously, the test from the Supreme Court says if it's clearly ambiguous, a town official could take advantage of that. But the fact that officials may have relied upon a town attorney opinion would, I believe, for those town officials that relied upon that, likely give them the ability to say it was, in their opinion, there was certainly no intent to defraud. There was no intent to do anything that was even contrary to what the charter would have provided. That our view was that may be on the fourth prong, that may be a factor that's, even though it may not be directly relevant to an ambiguity, which would be in the document itself.
Right.
That would be a factor that the court would look at, probably in the same nature it would look at an ambiguity.
Right. But again, it seemed like there were two parts that made you pretty certain that the fourth prong could not be met. It was the language in the charter, which you said doesn't expressly cover the action of entering into a contract which might obligate the town to incur expenses. Mm-hmm. You said that reading it with the Connecticut General Statute, it may be fairly read. It's still a little bit ambiguous, you could argue. But then to cement it up, you said that it was the opinion of the town attorney that the First Selectman and the various town boards and bodies relied upon. So certainly the town attorney's opinion seems to be kind of a linchpin in the whole fourth prong, and also, it leads to the discussion about whether legal malpractice action is something that would be appropriate in this case. Now, in your previous iterations of this report, did you mention anything about legal malpractice action against Attorney Saxel, or was that never on the table at all?
In the previous iterations of this report, meaning in the process of our drafting this report?
Yes.
We did not examine it as part of that process.
Okay. All right, that's all for now. Thank you very much.
Mrs. Leclerc?
Yeah, I have a question on the exceptions by the Supreme Court ruling that you said limits us. And the second one you said is that we receive fair value for purchase. But how could we have, if our 2003 agreement for $10 million, we were going to get a full train station, and now we've had to put up quite a bit more money to get the exact same thing that we originally had an agreement for? So how can you say we got fair value for our purchase?
I understand that I understand what you're saying, is that what you're saying is we wanted to get a train station for $10 million. We didn't want to obligate ourselves for amounts above that $10 million.
That's what our agreement was.
And it's certainly, I think you read that prong as the money that was ultimately spent, that was expended beyond what was appropriated, was to purchase something of value, of equal value. So if you bought a widget, it was for the value of a widget. If you bought a construction project, it was for the value of a construction project. So you got value for what those expenses were. It wasn't like you were taking the money and giving it away without receiving something in return of value. So if you look at it this way, if the original contract was a $10 million contract or a $10 million obligation or appropriation, and that was what the original 2003 agreement was going to require, if you get to the point where you have the expanded obligations, and now the cost is not 10, but it's an additional 15, and it makes it 25 million. If the $15 million you were obligating the town to and spending was buying, gravel and dirt and paying the manpower to perform the construction work, paying for consultants, there is a fair value received for that expenditure. It's not as if the money was just simply spent on something where there was not a value added to that property. That would be that would I believe would be the intent. It's similar to the fact that the next prong in the analysis says that nobody gained personal gain. So you bought something that was of value, and you didn't get personal. It was not like you spent the money on yourself or something that was not useful.
But I still don't get the part on what extra did we buy that we didn't originally agree to in 2003.
You bought additional construction.
But that was supposed to all happen back in 2003.
I understand I see your point, but what I'm saying is the money was actually used to purchase things and goods and services.
Okay. All right.
Anybody, I'll go back to Mr. Bolito as a follow-up to Mrs. Leclerc.
If I enter into a contract to buy a house for $250,000, a house that's worth $250,000, and through circumstance I end up paying $500,000 for that $250,000 house, is that fair value? Is that something the court would look at? You're getting the same house, but at a much more expensive price. The cost, the money, the dollars has to enter into what the value of what you're getting is and whether it's fair or not. Are there any court cases that you can cite that speak to that particular prong and the definition of value specifically?
If the cost of the house was originally $200,000, but the value to have that house delivered to you, signed, sealed, and delivered as your property was $500,000, you're getting value for it. Whether you think it's a good deal or not is a different story.
But
you're
is it
getting
fair
value for
value,
it.
though? That's the question. So we got a train station that cost significantly more than we originally contracted for. Yes, we're getting the same train station, but at a much higher cost. The question is, does that constitute fair value based upon the Supreme Court's interpretation of what that means?
I mean, obviously, there's no case on these express facts, but certainly in this situation, the argument can be made in a compelling sense that, again, while we don't agree that the process was followed properly, there was access to additional money, an additional $24 million, which would not be coming out of the town's coffers in the first instance. So there was a value intrinsically in being able to access that amount of money for the same station. That the project went above those amounts because of the obligations, there is certainly an argument, and a compelling one, that at the time no one knew that there were going to be cost overruns that would have gotten into the realm in which they have. So you're making judgment calls in some cases about fair value after the fact. What I'm saying is that if you go to a court of law, you have to be prepared for both of those arguments. And you've raised the arguments well. I think that would be a proper way to characterize it. But I think a court of law looking at it would say, when you look at these things from an objective value standpoint, there was a value for the purchase based upon those factors. And it's one in which you're fair to disagree with my conclusion on that. But I think that that's something that a court would have to look at seriously.
But that goes directly to what I'm asking, because you drew a conclusion that it would not be advisable or feasible to bring an action because of this four-pronged test. And what you're telling me is that no court has yet ruled on the specific issue of law about what constitutes fair value. So it is a de novo issue, basically. So basically, if you argue that in court, there's no precedent, there's no stare decisis in terms of what fair value is. So that prong is still in play very much in terms, from a legal standpoint. So an attorney could go in, argue that we get a train station that costs a lot more money than we had contracted for, that's not fair value. And while your argument certainly makes sense, ours does too, it's certainly in play where a court could go either way. Would you not agree?
I think a court can go either way on the issue of fair value. I think when you go to court, you can argue anything you want in court.
Sure,
Believe me.
absolutely.
We argue, lawyers in my profession, we argue lots of things before courts. Whether you prevail in court is a question of likelihoods. And on balance, our report thought that based upon the way in which the town was, the way in which the 2010 agreements were structured, people may agree with the bona fides of the deal, and may say it's a bad deal. People can go back later and say, anticipated things like that. There was a value to be received from the town as a result of that in the general sense. People can debate whether it's fair value, but where the court has this presumption against finding individuals liable, my view is that there's enough fair value there that a court would more likely than not find that there was fair value and find that that prong was satisfied. And that's what we stood behind in our analysis.
No, I understand that, and I understand that you're offering your opinion as a law firm analyzing these issues, but it doesn't change the fact that there is no judicial precedent directly on point with respect to at least one of the prongs of the test, correct?
There's judicial precedent on point on fair value, but I...
That's what I was asking
my
before. What
position
does
was
that say?
my position was that there was no, this specific set of circumstances is pretty complex with the tripartite agreement and state funding. But generally speaking, fair value is that you pay a fair price for the value received. It's not like you're spending the money on something that you're not receiving something in return. And in this case, you satisfy that basic test, but there are places that you pointed out where you've made some arguments that would be on the contrary side of the equation, but on balance, I think it would be very difficult to find that there was not value received for the monies that were expended over and above the original $10 million.
All right, so one last question on this point, as I don't want to kill it to death here, but if you're filing an appellate brief arguing the point of fair value, I don't know if you're a partner or not, but a partner in your firm puts an associate to work, do some legal research, find me a case on point that defines fair value as you're defining it. Is there such a case?
Yes.
Okay, what's that case?
I don't have the case. I don't have a case in front of me. If you want me to find you a case, I could find you a case.
Yeah, again, it's just to the point of, you've said on one hand that there's no judicial precedent, but then now you're saying there is. Maybe I'm just getting confused here, but is there a case directly on point as to what constitutes fair value?
As I sit here now, I can't give you the name of a case. But
Okay,
I know
fair
that,
enough.
I know that
I'm
the
putting you
case.
on the spot, I know.
But I do know that the case, the case was applied. These considerations were applied in a Supreme Court case, Armenio versus Butler, and they also came from a treatise, the concept of fair value. And fair value in the law has its own. It's a term of art.
Sure, I understand. Okay, thank you.
You're welcome.
Mr. DeWitt?
Thank you. I guess I'm a little confused on fair value and how you make a distinction between what we received for the money and revenue. Because our original agreement did say, I think I read it there, that we were going to receive the first $300,000 of revenue from the parking area, minus expenses of the state reimbursement. And then the 2010 agreement basically said, you're not going to be getting any of that money, or $1 million annually, something like that. I guess if we surpass $1 million annually, we'll get the rest, which will never happen, right? Plus maintenance.
Right.
How is that not part of fair value? We went into this project thinking, hey, it would be really great to have a third train station, but it would also be great if we were making some revenue off of it. We're $300,000 times the amount of years, we have this train station in existence out of that revenue. How is that not a piece of the fair value calculation?
Yeah, it's a fair question. I think it's something to fairly include in the fair value equation. The point here, I think, that led us to, again, considering all these together, and the binding letter agreement is a little bit different because it was sort of, it doesn't involve necessarily an expenditure, but it's a loss of potential future revenue, is really what it comes down to. Future revenue that today, we don't know whether the revenue would come to the town, because we haven't lived under an operating commuter parking lot receiving revenues to see whether or not it would cover the O&M expenses in the first instance, the ones that were contemplated. So at this point, we don't know what the damage would be. So going back to damage, that's what that is. But your question was fair value. The fair value analysis on that point would be, you got 19.1 million, and there is an assertion that the 19.1 was agreed to by the state because there was an understanding from what the officials said at the time, that this $300,000 revenue allocation would be adjusted the way that it was in the 2010 binding letter agreement. And that but for that, the state would not have either given the revenue over, or the state would have been able to terminate, because the state had some pretty strong termination language in the agreement, the state-town agreement, where it could have ceased to perform functions. So the point is, you're getting this money, the state has the ability, and they believe that the agreement is, from what I understand, their position is that agreement, or would be, is that binding letter agreement is enforceable, and they will not pay the town until they reach those revenues. So the point is, would you have gotten the 19.1 million to complete the project as it's now contemplated, without having given up that amount? And then subsequent to that, as I understand it too, there's additional revenues that the state has been able to make available by pluck or by luck to the town, in part because of the good faith. So the argument could be made, and I think it's a compelling one, that if we didn't give, quote unquote, the town didn't give the revenues, or change the methodology for receiving the revenues, it wouldn't have been able to get either the 19.1 initially, or on a continued basis, or later on, it would not have gotten the state assistance. That's part of the problem with dealing with the state, you know.
Sure.
So, you're the government, but the state's the, you know.
In a less eloquent way than you're putting it, it was a bargaining chip for
That's-
potentially a bargaining chip for the $19.1 million.
That's the point, exactly, and that's the contention.
Okay, thank you.
Mary?
I just had a quick question. You quoted the state statutes, and so I had a question. How could the state accept a contract that wasn't approved by the boards because it was going to exceed the appropriations? They knew we had approved in 2003 the 10 million in appropriations, but it never required or never went to all the different boards. By the state's own statute, isn't that required?
Well, the state statutes, if you look in the, and this brings up a different issue, but I raised a point in a footnote to the letter, and I'll tell you where it is, just so you can see. It is on page 17 of it's the long-form letter that was our Exhibit 2 in the compilation, but it's our letter dated September 30th on page 17 at the bottom. We quoted in there an Office of Attorney General opinion, and essentially the Office of Attorney General at the state level, which is the state's lawyer, officially the state constitutional officer that renders legal opinions on behalf of the state. While they understand that state statutes exist that govern municipal powers and actions, you have your own charter. And the Attorney General's office does not, as a matter of course, examine a town charter to determine what the appropriate process would be to be followed. And in this case, you did have town officials, and namely a town attorney who was charged with that process, indicating that this was something, presumably with respect to the 2010 agreements at least, that was something that was authorized on behalf of the town. So your point's a good one. If it happened earlier, why didn't it happen later? And I don't know the answer to that question from the state's perspective, but there were people saying that this was an appropriate process within the town, and that person, you know, those people were the legal advisors to the town at that time that were interfacing with the state DOT, its attorneys, and ultimately the Attorney General.
Okay, thank you.
Seeing nothing right now from my colleagues, I have a couple of my own. I wanted to go back to something you had said in response to, I think, a question excuse me, by Mr. Polito, where you'd indicated that in terms of damage and fair value and things of that sort, the one thing you were indicating was that there wasn't a lot of protest from other town bodies, and therefore it wasn't reasonable to assume that they weren't behind it, or you said it much more eloquently than I just said it, right? I want to be clear, though, and I don't remember the exact specifics, maybe Mr. Hiller does, but when this was first presented as having been done by the first selectman, there were questions raised, I know very specifically by Mr. Hiller, very specifically by our auditors, very specifically by myself, and well, I don't want to speak for colleagues, I think for colleagues on this board, regarding, did we have something we need to do here? Is there an appropriation process that needs to be gone through? You're kind of accepting money from the state here. And that was, as I recall, Paul, that was the genesis of that opinion letter that we got in writing from the town attorney, that, in fact, there was not a role for us to play, and that by what was done by a prior Board of Finance in 2003 and a prior RTM had given the authority to the first selectman to act in concert as much as he needed to with the Board of Selectmen to affect the train station. And that was the whole reason that that letter was drafted, because in fact, there were questions raised by some on other town bodies, including this one. Is that your recollection as well?
That is correct. In response to that, Mr. Chairman, I had spoken with Mr. Senafani, our auditor, who'd been appointed by this board, about it and outlined,
And me.
and I think in response to some of your concerns, had outlined to Mr. Senafani the details as we knew it from the meeting of, from the Board of Selectmen meeting and from the contracts were there. That precipitated a meeting which essentially Mr. Senafani and I called for, which was attended by myself, Caitlin Bossi, our controller, Mr. Senafani, Mr. Frank Cleary, Mr. Saxel, and Mr. Flato in mid-May. And I think the outcome of that letter
The outcome of the meeting was the letter.
was the letter some 3 weeks later. I had to go back and check my calendar and frankly, the bill from Mr. Cleary's firm. That meeting was held on May 18th at the First Selectman's office. And then Mr. Saxel's letter of June 10th was subsequent to that.
Right, so there wasn't, it's not fair to say that there wasn't questions raised by the other town bodies at that time, but we were basically told by the paid town attorney of what the legal precedent, and by the way, that happens relatively frequently where we rely on the advice of counsel within town government in order for how we move forward. So that's not, the bodies don't function if you can't rely on the sound advice of your paid consultants, whether that be your actuaries, whether that be your lawyers, whether that be your auditors. So I don't think it's fair to say, or your first selectman, I don't think it's fair to say that, well, there wasn't a protest put up, so therefore, that just oversimplifies the case. That letter existed because the questions were raised and we were given the advice that we were given, which now is called into question by your firm. And by the way, thank you for the report. I mean that. Thank you for the work that you did. But I just wanted to go on the record with that because that wasn't that's not what happened.
And I say for the sake of what a party would argue in litigation, who is
Sure.
defending his or her actions, that would be the contention. As I pointed out in the report,
Right.
we did say a few things. First of all, on the issue of of liability for individuals,
Right.
which is one way to blame individuals. We did give a nod that there was an attorney, there was a town attorney opinion that safeguarded it. And for the record, I will clarify that with respect to decisions made by people, as somebody who sat on boards, state boards, and the like in my career as well, both as a member and representing those boards, I know how the opinions of the attorneys are relied upon by folks. And I think that's why, in response to Mr. Bolito's question, I said that it would be very difficult to find individual liability for people who relied upon those opinions, because lay people who go into these boards on a volunteer basis, and the Supreme Court has found that that's the case in many boards. You may be professionals in your own right, you may be attorneys, but you may not be municipal attorneys who are charged with being able to understand this stuff. And certainly if you have the person charged with it, and who is the person who has interpreted the charter over time, and you've gotten to a level of trust in their interpretation, you rely upon those interpretations. And there's no question that that's happened before. It's my point is that the response back, the likely response back, and to the extent that it wasn't clear in this respect, was that no one stopped the presses. The arguments would be people wanted the train station project to be concluded. They didn't want a half-built Taj Mahal in the town.
Right.
And there was a wherewithal of people who sensed a palpable sense of relief when the project was going to proceed forward in its original form, and that it was not stopped by some other process. So there would be an argument saying that it still was able to proceed. That's my point. It's not that people were asleep at the switch by any means. I'm sure that there was vocal, and again, the letter from June 10th, which we included, was written to give comfort to the town officials.
Yeah. Thank you for the clarification of your earlier comments. The other item, if I could, do you have a follow-up to that specific?
To that point, I do.
Absolutely.
Please. On that point, if I'm following the dots correctly here, I'm on page 17, note 10 at the bottom, the page that you referred us to, and I'm just going to quickly read through something here to make sure that I understand it, because it's when Mr. Saxel was presenting to the Board of Selectmen, making his argument that this is not a contract, right?
Correct.
And he states that he did not believe that the state-town agreement was a contract, and that, quote, "the Attorney General did not think it was, and we went forward on the basis of the Attorney General's opinion as well as mine." Then you go on to say, "We find nothing in the record to support this conclusion. The Office of the Attorney General approved the state contract agreement as to form, but it does not purport to characterize the document as a contract or otherwise, ... So that would conclude to me that whether it was misinformation or negligence or whatever it could be possibly called, that was just very, very wrong information and incorrect interpretation of what the Attorney General opined or did not on whether it was a contract or not. So, I mean, back to Mr. Flynn's point, I just don't understand that. Help me understand why that information doesn't support his point.
That the town officials were reasonable, I believe that the
That-
chairman's
that-
point was
that we were unreasonably informed and led to believe that we were okay, and that it was not a contract, and all the things that followed.
well, I think,
Did I follow that?
I just want to make sure I answer your question correctly, because lawyers can sometimes be accused of not answering questions, so I want to make sure that I'm clear. We like to blame the other person asking the question, but let me see if I can restate the question and tell me if I'm correct, okay?
Please, it's late.
What you're saying is that the statement that is in footnote 10 regarding that I carefully listened to the videotape or watched the videotape to write that specific statement down. Does that indicate that the town attorney's advice was unreasonable and that we shouldn't be, that those officials that were on boards at that time should?
And a mischaracterization of the Attorney General's opinion on the matter.
Well,
Look at it from our perspective. Somebody sitting at one of these board meetings, whether they're volunteers or not, and they're listening to the town attorney explain something that is beyond our knowledge in most cases, certainly mine, and they're quoting his or her opinion, and they're also quoting a supporting opinion from the state attorney general. It sounds pretty compelling. okay, I guess we don't have to do that, or be concerned about that, or worry about that, so now we can take an action based upon that knowledge.
Correct. I think.
Or
that-
we don't have an action to take.
Exactly.
See, your point, yeah, your point's correct. Your point is correct in that, namely that if the town attorney's saying that it's his opinion and it's also the state attorney general's opinion, it gives you a level of comfort that your decision.
Well, yeah.
That it's an enforceable agreement, and now we're moving down the road. And I don't disagree with that contention.
Okay.
One thing about this, the statement that, you know, again, there was no attorney general opinion
Okay.
in writing, a formal opinion that was received, and you never know what people say as they're expressing a point, even a lawyer who's articulate and speaks
Right.
for a living in front of groups, whether it meant that the attorney general signed the agreement and as to form because they look at it and they make sure that it is all in order from the state side, or whether it meant that the Attorney General had to render an opinion. But I wrote the language verbatim so that
Right.
that folks like you could read that and derive what you believe from the actual language
No,
used.
thank you, and thank you for the follow-on.
No, thank you, Mr. Kiley. The other item I wanted to follow up on, one of the other items, I only have two, has to do with our role now, okay? So we're here today, what's happened. And we have competing opinions out there, one that said, in fairness to Mr. Saxel, he had an opinion out there as an attorney that said we didn't need to follow the appropriations. We didn't need to appropriate the funds. That was questioned. We got the letter back that said, from Mr. Saxel, again, that was his opinion. Now we have your report that comes out, right, and says, hey, this didn't go through the process. We think this is an issue, okay? This board has two sacrosanct responsibilities. Number one, the audit report that comes out every year. And number two, one of the things that we're entrusted with, along with everybody else, is protecting the AAA credit rating. So as we sit here now, the question I have regards, and I spoke with Mr. Hiller and Mr. Tetro about this previously. Do we have an audit problem? And do we have would the credit rating agencies look askew at the fact that this appropriation was never passed through the town bodies, but yet the funds were spent? So that's my biggest area of concern right now as it relates to my service on the Board of Finance. Now, my understanding to that, and I don't want to, and Mr. Tetra and Mr. Hiller, please correct me, my understanding on that is through conversations with our auditors, this would be a footnote disclosure that this event happened, and it would be nothing that would result in any change to the opinion for the financial statements or anything of that sort. Is that correct? I wasn't asking the attorney.
Oh.
But you can answer if you'd like, but I want to hear from the chief fiscal
I think Mr.
officer.
Tetro can answer too, but we have obviously spoken to Mr. Centofanti on more than one occasion.
Right.
On this. We have also sought, I shouldn't say counsel, but advice from Mr. Spurndle, our financial advisor, who has the primary responsibility of the direct contact with the rating agencies. In reverse order, I guess Mr. Spurndle does not feel that it's a significant issue that the rating agencies are going to be overly concerned with at that point. Clearly, when the audit report is issued later this fall, early winter, there will be a footnote, particularly on the capital projects report, because we still have, as of June 30th, we had an appropriation of $10 million. We have expenditures as of June 30th of roughly $28 million against that appropriation, and obviously a deficit. Obviously, subsequent to that, there has been another appropriation of $7.5 million, which this board has passed and the RTM has passed appropriately, but that's after June 30th. And that's still not going to clear up that gap that exists of some $18 million as of June 30th.
Could we get a document from Mr. Centofanti that tells us exactly how that'll be handled in the financial statements, please? Before the issuance of the financial statements, just, it doesn't have to be, a magnum opus, but it just needs to give this board some clarity as to what we're going to see. And what did Mr. Spurndle say? What was his reasoning for the credit agencies? Credit rating agencies not have a problem with it.
He, well, clearly, I think from a credit standpoint, there's full disclosure that that the bulk of all, virtually all of that money is committed from either from BlackRock Realty and/or the state of Connecticut. Obviously, the state of Connecticut money will also be revealed in the state single audit report, which Mr. Centofanti files with the Office of Policy and Management. He just didn't feel that it was going to, that it was of concern. It's a little bit different footnote, a strange footnote that's going to be on that audit report. And unless it were changed, obviously, that would also be on the audit report for the current fiscal year, too,
Right.
let alone the one for 2011.
Right. So I guess I'm going to come back to something. Right now, our advisors don't think that we have a problem with the credit rating agencies.
Not with the credit rating agencies. I think Mike can comment further on that, but we've been in recent contact with Matt on this, and you know, he's comfortable. Certainly, the credit rating agencies have been well aware of this for the whole for a 10-year period. That we've been trying to tell them that the train station's coming. The good news is the train station's here, and I think that's a part that.
And if we could get that letter from Mr. Centofanti. Mr. Tetra, do you want to add anything about the credit rating agency?
I think that the, just a couple of additional points. One is that the comment from Mr. Spindle was basically it's 6 of one, half dozen of the other. No matter what happens at this point, it's going to be reflected in one page in the chart, and there's going to be a footnote down below describing what happened or what didn't happen. There's no way to make it go away. It's a blemish to that degree. The other point that was made, and the primary audience for the financial statements, as you pointed out, is the rating agencies.
Yep.
From their standpoint, their question is, what's the liability?
Yep.
Well, there is no liability because that money was basically taken from the state, taken from BlackRock, and then spent. So there's not an outstanding liability to the town, so it doesn't impact the credit standing of the town in that case.
You would hope not, right?
So it's a process issue in terms of our approval mechanism, but not something that and Mr. Spindle's other point was that because as we're going through the rating agency presentations, we'll be able to clarify that at this point. They won't be uninformed readers, if you will, as opposed to a private company's financials and somebody looking at reviewing them from that standpoint.
Yeah. Number one, I thank you for doing that. I appreciate you gentlemen following up on that. I would appreciate that letter from our auditor. I wanted to raise that so that everybody else would know that those actions had been taken and that, but the other item I wanted to address is if that's wrong, that it would be a significant case of damages to the town, because it would impact our credit rating. And I'm not saying it will, but I'm saying the point is we don't know yet what all the ramifications are, right?
I think you certainly, you know, that no one wants to see their credit rating get impacted and can regard
Right.
that as a form of damage. Whether it's damage in the legal sense that would be recoverable in an action is something, it's a different story. But I understand your point, that it's a damage to the town in the general sense.
I just raise it because it's been, and I think, Mr. Tetra, I think what Mr. Spindle, I mean, I would agree with that commentary about the liability and the exposure, but until it happens, we don't know.
And it will also depend on what the explanation would be if there were any adjustments, because certainly we are still on thin ice with respect to the internal service fund and the reserves there.
Exactly, exactly. So I think it bears watching as to what next steps may be here And quite frankly, it might change your conclusion in that chart as we move forward. It could, as to what damages are. I wanted to raise that because I think it's relevant. The last item I had was thank you, Mr. Tetra, the $300,000 per year agreement. It's different understanding that you gave today that I had prior, so I just want to get a point of clarification on it. The $19 million contract with the state that was executed by Mr. Flato was done prior to the $300,000 contract.
That's correct. Based on the dates they were signed, the second agreement was signed several weeks after.
Several weeks after. So we don't know for sure that that 19 million was contingent on that 300,000 per year side letter, do we?
I wasn't part of those discussions, but all I know is the dates of, we indicated the dates of the letter, that's all we know at this
Right.
point, and the contentions of Mr. Flato.
Right, so did he contend that it was contingent?
That's my understanding.
Okay, because the $19 million letter was signed by both parties, the contract, prior to the $300,000 letter, which was signed several weeks later. So my question is, and I think it was raised at one of the other town bodies, is it reasonable to assume that there's any damages? You know, one of the things we're saying is, hey, the $19 million contract, although we might not like the way it was authorized, everybody operated with the agreement of that contract. That train station got built. The state was involved. The state gave the money under all the terms of the contract. So while we might not like it, it's an enforceable contract, right?
Correct.
The $300,000 deal, the side letter deal, though, if the 19 million was executed before that, we don't necessarily know that there was anything done with that $300,000 per year. We don't know that there was any damages to either party on that yet, right?
That's correct.
Is somebody looking at that? Now, I know, and Mr. Tetra will rightfully bring up, hey, we're in the process of doing this $3 million deal with the state, you know, the $2 to $3 million deal on the excess cost. I know we spoke about that just 45 minutes ago. But is somebody looking at whether that $300,000 per year side letter, is it enforceable, considering the fact that it never went through the town bodies, and to the best of our knowledge, nobody's acted upon it?
I mean, the question's been raised, for sure, whether it's enforceable, and I guess that there's a legal answer and a practical answer. Potentially, an agreement that's not done with proper authorization could be attacked on the grounds of its validity.
Mm-hmm.
But just to try to enforce an agreement, and again, we haven't done the analysis on that,
Mm-hmm.
but to enforce an agreement, you know, you've got to be careful what you wish for. If you pursue an agreement against the state does have certain immunities. There are certain limited rights that the town would have vis-a-vis the state as per the original agreement, in that you'd have to go through a Uniform Administrative Procedure Act claim as opposed to a direct court action. It would be a court action of sorts, but you'd have to go through an internal process at DOT. And it would be, you know, again, the state's going to determine whether you get intergovernmental revenues for things like infrastructure projects. So there's a lot of, as you kind of go into it, there's a legal answer and a practical answer. And in order to make a decision as a town, if you were to go down that road, you'd have to consider the merits of both, the strength of the legal position, and then also, well, what happens now if you pursue that course of action? And it's going against the state where they are cooperative in providing additional monies is a tricky dance.
See, the litigator of you came right out in that response, which is, hey, if you take them to court, how about if we call them up and say, you know, guys, we got a contract here that was never agreed to by the other town bodies, and we got a legal opinion that says that, quite frankly, from our side of the fence, this isn't a legitimate agreement. How do you guys want to handle this? Because we can't prove that anybody's acted upon it right now, and we have town bodies that are questioning it.
Those conversations certainly could be had, you know, and again, depending, you know, and what my recommendation to the town would be just to do an analysis of that and just weigh the pros and the cons before you make any, like, with respect to any affirmative litigation or even position in negotiation. Just be aware of, of the party's power with respect, the party's
Yeah.
powers.
Yeah. No, because I certainly wasn't going to the court route. I was going to the route that have we notified the state that we have these agreements sitting out here that we don't think properly went through the town bodies. That's all.
It's my understanding there's been no notification of that
Right.
at this point.
Okay. Thank you. Thank you very much for your time on that. Any other questions, comments, Mr. Kiley, Mr. Brock? Thank you.
You're welcome.
Mr. DeWitt?
No, but having said what you just said, why don't we start the formal process of having the boards agree or not agree with that 300,000?
I'll go to the,
That's all you want.
yeah, to the administration. Any thoughts on what's your position right now in the $300,000 per year agreement? Yeah. And I'm very cognizant of the $3 million deal that's out there, so that's why I'm not pushing in any different direction on this.
Yeah. I think at this point, we got this opinion on or about October 3rd. We had the first Board of Selectmen meeting. We had the RTM meeting on Monday night, and we had this meeting tonight. We're still digesting some of the comments and feedback through all this, so I'm not going to suggest that we've thought all that through and have that direction at this point.
Okay.
We also have some additional tasks or questions for Attorney Vitarelli based on some of the questions that came out of the Board of Selectmen meeting, so we'll be following up on those. And based on those, we'll come back to this. From a standpoint of time sensitivity or urgency, it's going to be a while before there's any significant revenues coming out of that would approach anything. I think that one of the other issues here is, and I believe it was someone on this board, possibly Chairman Flynn, that asked as one of the 58 questions, where's the pro forma as part of the original deal, and where's the pro forma as part of the 2010 deal? If you remember the answer, there isn't one.
Right.
So we went back and said, okay, let's pull and the Fairfield Parking Authority is a separate state agency. They don't get any tax revenue, so they have a separate financial statement. So we copied that and distributed that out to the bodies, including this one. And there's a reasonable number of expenses. The revenue, $400 a permit times $1,000 is in the 400,000 range.
Some expenses with that.
There's not much over that. At least initially, they won't be overbooking the parking permits to the extent that we do at the Fairfield train station.
Isn't it 1,500 at 420 a pop, though?
No.
I thought it was.
Let's see, the math at the moment
Right.
is there are 1,369 parking spaces.
Right.
That is less than 1,500, one part by the actual design.
Yep.
Forget we think it'll be 1,500 part.
Right.
One part because of certain subtractions. The state actually wants bus service at the
Yep.
station. That takes a whole big piece or section of parking spaces. There's a taxi stand. That takes another set of parking spaces. And to a smaller degree, there's handicap parking spaces, which I don't mean to paint that as a big picture, but each one of those parking spaces is bigger than a parking space. So all of that boils it down to 1,369. Now let's take the 1,369, approximately 200 of those are going to be day parking. So that gets us down to 1,169. And then, so that's kind of
But, and then they oversell it by, or at least at the Fairfield downtown, they do it by
downtown one,
5
they
or 10%.
oversell almost by twice. It's 0.9.
Is it? Okay.
When you, yes, we
Yeah.
did the math, and I
Yeah.
believe if you go back to the analysis that
Yep.
came along with the pro forma or the financial statements from, you will see the math with that breaks all that out for you.
Right.
In this case, and in our question to DOT was, okay, how many permits are you going to issue? What's going to be the impact on our
Right.
4,200-person waiting list? How many of those come off? Or the other way, how much are you going to overbook? Initially, they said not by that much. So they're looking at something in the 10 to 20% range. I think the actual most recent statement in writing from them was 0. But the verbal statements, going back a few months, were 10 to 20% until they see kind of how the dynamics work out and how things fit. So that limits the revenue, if you will, on the upper end.
Yeah,
You'll
you're
have
still
the,
up to like 1,300 if they do it by 10 or 20%, right?
well, you'll have the $400 for that, but then the 200 day parking, actually, you'll get more money per slot
Exactly.
per year because
Yep.
it's a higher, assuming they all book out, and you can make that assumption for the moment. So that the total might
Just
be.
$6 a day or something like that, right?
Yeah. And again, you can go back to the Fairfield numbers, see kind of what component of that is, but if it's 400 plus another 200,
Yep.
that's 600 total. You subtract some expenses off of that. And again, because there's no statement from the state as to what all the expenses will be at the new station, it gets very difficult to
I understand.
put that away, and so that's kind of where we're in the dark in terms of the likelihood of getting the 300,000. Certainly, when you look at those revenue numbers, the likelihood of getting it after they count the million in is very small.
Yeah, that I agree with. I agree with that after the million per year. Yeah.
Okay? That help?
Does. Thank you. Any other questions, comments, concerns from board members? Thank you very much. Thank you for the report. Thank you for the time.
Appreciate
I
it.
appreciate the administration's time. Thank you. All right, we're going to item number 4 on the agenda, to hear a report on the status of revenue and expenses related to the budget for the town through the end of the first quarter, September 30th. Take.
Good evening, Mrs. Gardner.
Good evening. I'm cognizant that you have another item after this to pass. I don't want to give this short shrift, but perhaps I can do a summary and
That
try
would be
to,
wonderful, thank
try to
you.
organize it. We continue to strive to improve our quarterly report with the guidance of our first selectman. You will notice a couple of changes, and I'd like to go through those first because it might preclude the need for some questions.
Sure, go right ahead, please.
Okay. I'm going to skip past the text for the moment and go right to what we call the seasonality report. We have just organized it a little bit differently. You will see that although we still address all the seasonal items, we've organized them according to their fund.
Okay.
All right, so the first group of items will be your general fund revenue. Your second set of items will be your general fund expenditures. And then there's a little line that tells you where the general fund ends. On your third sheet, you'll see those seasonal items that will impact different funds. The self-supporting fund, which is the Water Pollution Control Authority, the Internal Service Fund, and then we've added a new little look, and that's the project fund expenditures. And those are that identifies the large projects, what we've spent to date, and the net. A second thing we've done, and I just want to say this at the onset. Although you've received the Munis reports, the numbers on your seasonality report are updated to reflect any preliminary invoices or any other information that we could gather so that we truly have a 3-month look. So if you might, for instance, look at unemployment comp on your expenditure report and see it's 40-something thousand, and on the seasonality report, it's updated to reflect invoices that have come in but have not been actually paid yet. Gives you the most current information. So with that being said, one other change on the report. If you look at the variance, the dollar variance is between the 3-month actuals to the 3-month budget. But we're giving you a percentage of actuals to the total budget. And we're also comparing that to the same thing in the prior year. The reason for that is this is truly not a quarterly report. A quarterly report would do July, August, September. Your second quarter would be only October, November, December. What we do is the first quarter is 3 months, the second quarter is 6 months, the third quarter is 9 months, and so on. So I think the change in the percentage will help you kind of see where you are at that period in time,
Okay.
as we move through the year.
I'm sorry, Mr. Kiley has a quick
Oh,
question.
Thank you,
yes,
sir.
Kevin.
Linda, does that mean that the July-September budget is not 3 months of budget, it's really 25% of the annual budget? It's not, it's not month by month or quarter by quarter, it's really 1/4 of a year?
No, not necessarily,
No?
because our budget allocation really reflects our history, and I could talk about that if you'd like a little bit. It's not necessarily a straight quarter. Remember the sheet you people received a long time ago? With Munis now in place for a couple of years, I'm able to capture some information. We don't expect to receive 25% of the revenue of the current year levy,
Right.
for instance, because looking at history, we've received 28.5%, 29%.
Right.
So we budget an average of those actuals as we capture that information. And speaking of the current year levy, for instance,
Okay.
we're running ahead of what we expected to collect in this quarter, not because performance, not because we expect to receive more revenue than we anticipate at the end of the year, but because of timing. We've actually received 31% of the total budget, and we were only anticipating 30 based on history.
Okay.
So maybe with the
That
economy.
explains it, no, thank you.
Okay, good.
Go ahead, Paul.
If I could just add to that, Kevin, I think Linda's given a very good explanation, but what we're trying to do, given the data that we have, and now into the third year of this, is really, it is clearly a work in progress. And as we capture more data, we're going to have to, or not have to, but we should tweak some of these numbers a little bit as we go along, as we find patterns. Some accounts, there's no particular pattern, but there is some seasonality with several of the accounts, and we should be able to give a better.
Thank you.
And in answer to someone's question to the Board of Ed, we actually capture the data month by month.
Right.
So we can see quickly if something's going off the rails. And I just
Did you have a
wanted to
question,
reassure
Mr.
that.
DeWitt?
Just real quickly. Sure. So I understand the 31% versus 28%, but of course, we're talking about revenue. Do you do anything to equalize those two numbers? For example, if the current year levy at this point in 2010, 2011 budget was 25% of the budget, but in this year's, it's really 30% of the budget based on other revenue projections?
As I'm collecting the data for the years, I'm using a running average.
Oh, okay,
And we
great.
have moved that up.
Okay.
And next year, you'll.
So this is
it-
really apples to apples here.
Yes,
28 to 31.
absolutely. And next year, that running average will use the two
We'll get
prior
better every
data.
year 'cause we get
Yes,
more things
yes,
to average against,
yes.
right.
And I did tweak the numbers, so these are not the old allocations that we used last year for that very reason. Okay, now we can go back to the text, now that you've understand that we've kind of
Do
sharpened
you have a
up our
question?
our
I'm
tools.
sorry, Ms.
Oh,
Scott. Do you have a
I'm
question,
sorry.
Mr. Brockville?
It's a numbers question, so I don't want to,
Sure, go right ahead.
oh, okay.
Maybe.
A numbers question? I forget. No, I'm kidding.
Yeah, right. Yeah, we don't do numbers.
That's all we're here for.
Science, yes, numbers, no.
Right.
And I apologize, it's late, so maybe I'm drifting in and out, and I apologize.
No
but,
problem.
I'm going to my favorite line, but interestingly, there seems to be some math things I don't understand. So if you go to interest on investment income, on your
the-
seasonality report.
Okay.
Right? So,
Can you use your mic?
oh, I'm sorry, I moved it away when we were doing that legal presentation. If you go to the interest on investment income line, which is the first page of the seasonality report, about 10 items down, it says July, September, well, I have two questions, really.
Right.
I mean, so July, September budget, 180, and yet I know we budgeted $1 million in the budget, so shouldn't that be 250?
No, because I'm not going by equal quarter, I'm looking at past history.
Yeah, I
what we
knew I were
collected.
going to get to that. That's why I
Right.
apologize.
However, we are still under what we should be, even for this being a low quarter.
Right, and then,
Yeah.
right, and then the second
Absolutely.
question along with that, and again, I apologize, maybe I just zoned
No,
out,
no problem.
is it says a difference of 104,054, which doesn't match up with anything.
No, what that matches up to is the year-to-date, the July through September actuals to the July through September budget, the difference. What we expected to have versus what we actually have.
So what you're doing is
I'm giving you an actual and dollar amount, and then your percentage
so
is based on the
you're looking at
budget.
history as to how monies have flowed through?
Yes.
And adjusted?
Yes.
Paul, you look like you agree
Yeah,
or
and I
not?
think one of the problems we've had with this line, and it's been, one of the difficult ones to really take on this is, first off, there's a lot of money that was received within the quarter, which were an accrual against last year. I think that number was $134,000 that was received. That number will, or
Wash out.
maybe not the same number, but there'll be a significant accrual on June 30th.
Right.
Is one of the other factors there. The other thing is the market value, which we only are taking on an annual basis.
Right.
We haven't, impacted that.
No,
The market value was positive this year.
No, I appreciate that, and I think we all understand that.
Yeah.
Mine was more of a math question. I just
Okay.
didn't understand how the
Right.
numbers
Yeah.
added up, that's
Right.
all. So you've explained it, I appreciate it.
Yeah.
All right, so I'm going to start at the top and go through. We've already spoken about the current year. Prior year, we're running a little bit below. However, there's no predictable pattern to foreclosures, and this is one of those accounts that you can't say, we've traditionally collected so much in the first quarter, second quarter. This is really driven by other economic conditions. So we fully do expect to collect this, the budget, though, by the end of the year, so we're not raising any red flags yet. Building permit revenue is down $45,000, under what we expected for the first quarter. And I've listed for you the buildings and an estimate of the permit revenue we still expect to come in. So this is probably lagging as a result of economic conditions as well. We're expecting to collect this. Pilot will be $197,000 under budget because the state allocation is final, and and our budget was over by the 197.
So we've got a hole of 100.
We've got, that's a hole. That's a
Okay.
hole. That's not going away, and it won't improve. Conveyance tax for the first quarter is $11,000 under budget. And our recorded sales were down 194 over last year, same quarter, 242. Again, economic conditions, so that's a little bit hard to predict the timing on it. Golf revenues down $59,000. This is really interesting. Bad weather. I know you've heard that before, but really bad weather. Jerry did an analysis, and just for your information, on a weekday, Smith Richardson will collect $6,000 a day. On a Friday, $8,400 a day, and on a weekend, either a Saturday or Sunday, $9,400. In this year, we had 43 cart path days. That meant the weather was bad enough, soggy enough, that you couldn't go on the greens, versus last year, 16 cart path days. And of those 43 cart path days, 11 of them were weekend days. So it was at a much higher rate. And so he's hoping with improving weather in the spring to make that back up. We'll see. Interest on investment, we discussed that. And then what we've added is an all other revenue line, which is really a plug, so that you can.
Bad word, don't say
No,
that.
all right, I don't want to say plug, no. We've never tracked this before, we're beginning to track this. I don't have history on everything else summed up in aggregate. So I may not have the history to explain it as well as I would like this first go-around, but we'll be collecting that, we'll be capturing that as we go. We'll be doing this for expenditures also. You'll see this at the bottom of the expenditure side. And on to expenditures, legal services, right now, we're $9,000 under budget. We think we'll be okay there, pending other decisions that will be made in the future, and we'll discuss those as those happen. Risk management, heart and hypertension is $183,000 over budget. That could look a little frightening, but in 1 week in July, the town had granted a permanency award, and one individual was hospitalized to the tune of $204,000. That happened in 1 week. It hasn't occurred again in this quarter. Doesn't mean it can't happen, but you just get those outliers. You never know when they're going to pop. So we've kind of settled back down to a more level spending, and we hope that that will continue.
But that level of spending isn't really making up dramatically the overage, so this might be an overage that you have to live with.
It just may, well, again,
It may be, it's, you know, there has been, I think this board can recall, I think it was 2 or 3 years ago where we went over on this line by $250,000 or $285,000.
Yep.
It is a very difficult line to accurately.
this is one line that I did predict equally across the year, because it's been all over the place. I haven't really developed a history for it yet. So that could be due to our lack of, well, you never can tell when someone's going to have a heart attack. That's the problem. And there's no seasonality, you know, no seasonality to that. Okay, unemployment comp. Here's something we need to keep our eye on. Here's a red flag. We are $51,000 over budget. Of the $100,000 expended, $70,000 is attributable to the Board of Ed. And I did a little analysis of the positions that they laid off and those that they've recalled. So we expect that they will perform better, or in other words, our bills will decrease in the ensuing months, but we still are going to have 18 positions remain terminated. So we will track that a little more closely in the next period, and we can give you a little better history then. But it's something that bears watching. Fire, payroll, and overtime right now looks okay. I just want to bring your attention to the fact that $47,000 was expended in overtime business due to Tropical Storm Irene. 75% of that will be reimbursed by FEMA and will come back to the department, but the department will be responsible for eating 25% of that cost, just so you know. Police and fire, oh, sorry, yes.
Fire.
Yes.
So at the end of last year, we overspent the overtime earnings vacancy line, excuse me.
Okay,
167%, right?
okay.
We did that at a rate of 40% spend to the budget for the July to September actuals.
Okay.
Now we're at 31%. So
Chris, just tell me, what line are you looking at, vacation or vacancy?
I'm looking at vacancy.
Okay, gotcha.
Again, at
Right.
the end of the year, last year, before we did all our reconciliations, right, we were overspent. It's about 170%.
Okay.
It was actually $210,000 overspent at the rate that is shown here for July to September. So this means that we're likely to overspend that line. God bless you.
No, the reason why that may appear a little funny is I have done equal budgets through the periods, because we're still trying to gain our sea legs on this. Last year, you're correct, we spent 32%, but the prior year, we only spent 18%. So until,
The vacancy?
yeah, so until we have a better history, pick it. I kind of,
I guess
25% was kind of in the middle.
I guess what I'm trying to say is, you said, oh, we're all good fire, but we're on a track to overspend that line item again, more than $200,000. Just based on simple history. Last year, we overspent in July, September, we spent this much. July, September, they're kind of in the same ballpark.
Well,
I don't know whether it would be two- I don't know if it's 200,000.
I do have to tell you one thing. Last year's quarter, we only budgeted for 1 month of vacancy, and they actually started spending earlier. The budget was intended to start on September 1st, and they actually employed those positions throughout the quarter. So that's why it appeared as if and we did overspend, because we only budgeted 10 out of
We
12 months.
budgeted last year and this primarily is being driven by the ladder rescue, the extra man
Right.
in an overtime position. That's where these costs are being
So
reflected.
we have budgeted for
The
12
good
months.
news is, because this
Potentially,
line-
there should not be a hole, other than the storm Irene.
Okay.
At this
Which
point,
we can
Bears
talk about-
watching.
we can talk about when
Next,
you get to that portion, I don't understand that, but.
Okay.
So, on that line item, we're 31% spent, so.
Right.
We're kind of a quarter of the way through the budget, so that's on par.
right,
So, maybe we're not looking at
that's right.
the big hole that we had last year.
Right, I'm not panicking at this point.
Good news, thank you.
I'll talk to you in January, though. Okay. Police and fire payroll, taken in aggregate, those lines were 115,000 over budget. And I just wanted to call your attention that police expended 48,000 in overtime replacement due to the storm Irene. But police also are running a little bit higher in overtime replacement because they had 4 vacancies, 2 of which will be coming online, I gave you the date, on November 1st. And the other 2 vacancies will be carried throughout the year, so we should see the
But
overtime
we
use.
didn't get the savings, is that because we had 4 in the academy, so we were
Ye-
paying them, but then in.
Right, and we're still paying them, and they're really not online
Know
yet.
that when we did the budget?
I think we budgeted for 2, not for 4.
What happened? Did 2 retire, 2 quit? What?
I did an analysis of one who was on extended injury. I'm not sure about the other.
Well, we wouldn't be sending someone to the academy if they're on extended.
No, that's just an extended injury case. I'll look into that and
Okay.
get back to you, because, I probably remember the answer, but now it's so late, I can't recall it.
They're usually
Oh, they're
very
usually
buttoned
on.
up on this. so
Yes, they
this-
are.
So I can't, if you came in here and said they were over by 50 grand with the 49 being due to Irene,
No
I get
sweat.
it. But being over by 115,
Yeah. Yeah,
that's weird
I'll,
for them.
and I'll email you all tomorrow with that answer.
Thank you, Linda.
Utilities, we're fine for now. We'll watch that over the next 3 months.
Is that rate or just our utilization, do you know? Did we save on the rate, or did we save on?
No, I think we budgeted better, and I also have preliminary bills built in here. Whether those preliminary bills, invoices come to meet my estimates, we'll see. That's why we'll know better. But I think we're going to be fine. I have every confidence we'll be fine there.
I think the other thing that's going to happen here is we've bought, particularly on the electric, we've bought electricity at a very favorable rate, but it doesn't kick in until January 1st. So, we've got a rate that's under our budget. So the first 6 months may be skewed higher because of the, on the generation piece.
Well, I'm not going to jinx this, I'm not going to say it. I'm not going to say it out loud.
Don't jinx.
Yeah.
Okay, Public Works, well, okay, now we can raise a little red flag here. We're 174,000 over budget. But I want to let you know that Tropical Storm Irene has cost the Public Works Department what they've already expended in this quarter, $215,000 in contracted property services and $125,000 in overtime. Now, 75% of that will be reimbursed back to the department, but, we're actually 400 and something thousand over right now, over in usage. So really, the Public Works Department is really under budget if you want to remove the Irene's.
So the net is that if we're a little over 400,000 in the hole, if you add it all in.
Right.
75% reimbursable,
Right.
so we'll get 25, so we'll be 100,000
160
over, of which we're already under, so you've covered it.
Well, let me, no, wait. There's
Okay.
there's another piece to this puzzle.
Okay.
The superintendent of Public Works estimates that it's going to cost another 233 and maybe even more to repair storm damage from Irene. So we're not quite done spending out of this budget.
No, but that's where I got the 400,000.
No, no,
Real-
okay.
Because you spent,
We've spent to date 435,931 on Irene. That's in those expenditures. Those are in the actuals. But yet, we have yet to spend another 233,000.
okay, wait, so in particular, Scott.
No, you're right what you were saying, Tom, though. I know what you're saying.
Well, yeah, but in particular, Tropical Storm Irene caused extraordinary expenditures of this and overtime. Okay, so that's 330 is what I get total.
Okay.
And then I'm saying 330, plus you're saying, hey, we've got another 233,
Yes, that's what I'm saying.
right?
yes,
So
Tom.
330, 233,
It is
that's 560. Okay, so it wasn't 400.
Okay.
So then, and I do the math there.
And we're on the hook for a
Getting
quarter of that.
75% of that back, right? So you're roughly, you're over budget by 174, so I kind of get it. That'd swing you back to your earlier point, under budget. But then you have the problem with the additional cost for the fire station.
I'm just going to bring that up, the
Yeah,
oil
that-
tank.
That's the other one
That's
that's
the
out
other
there, that
bugaboo.
particularly when you look at this on the next quarter,
Mm-hmm.
when we take all those costs, I mean, the fire station costs are going to be in here.
Yeah.
And that's the one we have to
biggie.
remedy at some point after the first of the year.
So we have to hope for a real mild winter here.
Yeah. No,
Well,
so-
it's, yeah. I think we're going to have to look at this one hard before the budget season, but, you know, I would think at the latest by the February meeting.
So we will be watching this very closely, especially
Yeah, this is a
in the
problem.
next quarterly report. I'm sorry?
This is a problem.
Yeah, oh, yeah,
Yeah.
it's a problem.
Yeah, please.
Mrs. Gardner, the 233 that is estimated more to repair damage from Irene, I'm seeing attached.
Yeah, there's a whole group of attachments, and
Okay. Which one is
it's
it?
in a memo,
Okay.
yeah, toward the back. And
Just
Scott,
quickly point me to what that additional expenditure is.
okay, it's a list of things.
Okay.
It's a memo from Scott Bartlett to myself. It's on the first page regarding Irene.
All right, got it.
Looks like a bunch of numbers.
Okay. You've got the Southport Beach seawall, 50,000. And if you go through that list, that's where those items and those costs,
What's in the front of it? What was in front of it? Oh, got it, okay.
that's the summary of the 233,000
So
in additional costs.
The big one I'm seeing is $100,000 for Penfield Pavilion, but could be qualified for special 404 mitigation money. What is that? I mean, you might not know that. That's from
I
Scott
don't-
Bartlett, so.
I-
Does that mean there's
One-
reimbursement available, or?
Let me find out.
Sure, okay.
The one that I would bring to your attention that is on this list, which has been in previous budgets, which FEMA has allowed for, is towards the top of that list, is the Perry's Green Park. This is the
Yeah.
park down in Southport, public park adjacent to the Pequot Yacht Club.
Right, okay.
That wall, as you know, has been on what Scott refers to as the sheet piling replacement. That has been on the list for several years for a capital project. FEMA has basically agreed they'll pay 75% of that if we pay the other 25.
Okay.
Now, we got to figure, again, I think that's one of the things in the total context of Public Works we've got to look at. We knew it was coming at some point. It's been on the list for probably the last 5 years, and we got a chance to get 75% federal money on it.
Sure. Makes sense.
But
Okay.
we don't have, the number is a lot more than 15,000 for the full. We don't have that number yet.
And on this, and also on Public Works, the 365 in additional costs, the memo in the back indicates that you might be coming back to us in January for some further action on that. So you might not try to take that into the entire operating budget, depends on what happens there. Right? Okay.
What's the sheet after? Estimated contracted storm, Irene, clean up that total 215?
Oh, that's the oil tank?
No.
No, I'm sorry. It's page 2 of the memo you're talking about?
Oh.
Oh, that was just the cost of how we expended that, 200, yeah, the 215 and the 125, yeah. The contracted property service,
Control of people we
yes, and what we paid them for the,
pulled by.
I will,
All right. Any
Okay.
other questions, comments, concerns, because we're getting a little bit late in the
yeah, and
hour.
there's really nothing else to talk about other than those big items, so.
Any other items on September? Okay, yeah, Chris.
One more in here, quick. Linda, why is our budget rolling up in your latest estimate to $268 million?
Oh, what happened is that also includes water pollution control.
Ah, okay.
It added both funds.
Okay. And then my
It's
last question is,
260.
there's an additional $338,105 of transfers and adjustments. I'm curious where that's coming from, because there's only one minus in the whole thing, and it's in
Yes.
the library. It's a big minus, $630,000.
That's because we just transfer the materials account to different projects, so we take it out of the main line item.
Took out 630, and you only
That's their book
went back
account.
480.
Oh. Right.
You got a net addition to the
Right,
budget
they
of 100
because they they had open POs for 200,000 last year that they carried over. Those open POs carry over in the transfers and adjustments.
Adjustments are for
Not necessarily, but in the case of the library, that's what that is.
so I'm still kind of confused as I am every year how we treat
I know.
what the transfers are.
I know. Unfortunately, Munis has only one column for, I know. I know, we discussed this the last time, I remember. It is very confusing.
We don't know.
Yes, we do know. Open POs to purchase the books.
The whole $338,000
No. There's
transfers
400, no. What happened is, we give them one line item for materials, 400 and whatever the budget is. Let me
I'm
look
with
it
you
up.
with library. If
Right,
library
right.
reconciles, then
Oh,
we're
okay,
fine.
okay.
But there's still other transfers
Right.
under other accounts.
Right, yes.
Where do they come from?
Well, they're your schedules, C and D at the end of the year. A,
The
B,
ones that
C.
we approve
The
at
ones
the
that
end
you
of the year.
approve, yeah.
So all-
I can get you those
All the
schedules.
transfers are schedules we approved.
Yeah,
Okay.
yeah. Oh, yeah, we have, you approve the carryover of POs or encumbrances or whatever.
Answer that.
And I can get that for you next time
No,
if you
that's
want.
fine. If they're in the schedules,
Okay.
then that's fine.
Yes, they are, they're in the
You all set,
schedules.
Mr. DeWitt?
Yep, thank you.
Any other questions, comments, concerns? Seeing none, thank you. Mr. Hiller, you had one item. Thank you, Mrs. Gardner. You had one item.
Yes, at last month's meeting, we had several transfers to correct overdrafts in various accounts, and in the final accounting, going back through, we were short on the Public Works account, which by some little over $15,000, and request that the board act upon a transfer from within the Public Works area. There's vacancy money available in the engineering department, and move it from engineering to Public Works.
Okay. Thank you, Mr. Hiller. Questions, comments, concerns on this transfer? Seeing none, do I have a motion? Do I have a second? Okay. Questions, comments, concerns from the public? None? Back to the board. All in favor? Opposed? Abstentions? That transfer item carries. I have no other communications to discuss tonight. I know it's a late hour, but I'd like to take a moment of personal privilege if I could, and perhaps Mr. DeWitt would as well. I don't know about others. But barring our need to hold a meeting next week, this will be our last meeting before the election, and possibly several members' last time on the board. I want to thank you all. I would be one of those members, and historically, historically, at the end of any given term,
Thank you for your service.
at the end of any given term, at the end of any given term, I've thanked the members that were up for reelection or leaving, and I would just like to take the opportunity to thank all the members that I've had the privilege to serve with in the past 6 years, both past and present. Thought I knew what I was getting into when I joined the board 6 years ago. It's been much more rewarding than even I could have thought. Thanks to the people of the town of Fairfield for giving me that opportunity. One of the most rewarding parts of it that I didn't contemplate when I first started was how much I would enjoy working with all the members. And as I count many of them, past and present, as friends. So I wish everyone good luck in the election. Some more than others. No, I'm kidding. Good luck in the election. And thank you for the privilege and honor of serving with you. I'd also like to recognize Ms. Stenick, who's finishing out her term. You've had quite an eventful term. And once again, thank you for your work as the interim first selectman. I know I greatly appreciate it. I know the town does as well. And we wish you the best in the future. So thank you. Anybody else have anything to say? Mr. DeWitt.
Thank you, Mr. Chairman. I would also like to thank everyone for allowing me to be here for the last 4 years in taking over Dee Dee Brandt's term. I said the other night at the debate that one of the things I've learned is that volunteerism in this town is alive and well, and I really think so. I really agree with that, and especially in this board, because every time something comes up, let's have a committee about the Metro Center. Let's have a committee about something else. There's always somebody volunteering. In fact, sometimes there's too many people volunteering, and we have to say, you'll get the next one. So it's really been a pleasure. It's been an eye-opening experience for me. I'm frankly going to miss the board that we had, I'm going to include a couple months ago with Mr. Tetro, because this was really quite a mix of very genuine people, and it's kind of no fun not having Mike on this side of the table with us anymore. But
inadequate.
But yeah, and as in any work environment, a lot of times you don't miss the work, but you miss the people. So hopefully I won't have to miss anyone. But again, thank you for the opportunity.
Mr. Bolito.
Just really quickly, this may or may not be my last meeting on this board, depending on what happens on November 8th. I could be any number of places. I will still be holding the annual Board of Finance holiday party at my home. Mike will be more than welcome to come as will all the members of the Board of Finance, so that's not going to change. All kidding aside, though, this is a great group of people. It's been a privilege to work for the last 4 years on the Board of Finance with some just great individuals across the board. And however things turn out on November 8th, worst case scenario, you have me to deal with for another 2 years here on this board, or you'll be dealing with me in some other capacity. But I just want to say how grateful I am for the opportunity to serve the town of Fairfield on this board. And however it all turns out, I look forward to serving the town for many years to come. So thank you very much.
Thank you, Rob. I would be remiss if I didn't wish both our colleague and our former colleague the best of luck in the municipal election. I'm lucky to count both of you as my friends, and this town is lucky to have such quality people to choose from. So best of luck to both of you. So with that, motion to adjourn? Bob, Rob, and Rob, all in favor? Opposed? We're done, guys. Thanks.